everyone was talking about a 9 to 10% return. Guess what? Portfolios were down by 20 to 25%. So everyone's interested to see where does alpha get generated this year? Also, what are the top themes and what are the contra bets? Because that's going to be rather interesting. A couple of sectors like real estate and IT, they have done absolutely nothing. In fact, stocks are down between 10, 20, even 30% out there. So can some of those ideas come up as contra bets is going to be important. And also market men's view. Gold versus equities. Well, we have been talking about various ratios. Gold continues to move up. It's got safety buying as well that we see, safe haven buying. But will equities finally have a better year than gold? That's going to be top of mind because as of now, a lot of investors going by the start that we've seen to 2026, they're getting a little bit jittery. We start markets at around 9 a.m. By around 11 a.m., we've seen numerous times that the markets have been under some pressure. And we have been seeing recoveries from there. But otherwise, 25,500 important on the Nifty. I'm waiting by to hear what our market men have to say, Shireen.
Yes, and you can see our market experts on your screens there, Ramdev Agarwal and Manish Chokhani. They're going to be kicking off the market forum. But, speaking of themes and sectors, question for Ramdev from my side, Nigel, will really be on how this e-commerce, quick commerce story is likely to pan out. That's a big bet that Motilal Oswal has made. They've put in a significant amount of money into Zepto. There seems to now be a lot of regulatory pushback, of course, as we reported today a short while ago, that the ministry has nudged quick commerce companies to drop the 10-minute promise from their marketing and branding. So what does Ramdev make of all of this and the likely implications for that big IPO that's awaited Zepto, which is, of course, likely to be one of the big IPOs of 2026? That would certainly be one of the themes that I would like addressed, Nigel.
Well, indeed, Shri, we're going to be keeping an eye out on that quick commerce space. And as you said, Zepto IPO, but there are a couple of other big ones as well we're looking at for this year. Probably we could see an NSE IPO, probably a Geo IPO as well. So that's going to be top of mind because we know 2025, we had a flush, in terms of IPOs hitting the markets. And the problem was there was draining a lot of money out of the system as well because we keep talking about these SIP flows that are rock solid. The problem is the supply of paper is equally as strong. So in a few minutes from now, we'll hear from the man himself, Mr. Ramdev Agarwal, as well as Mr. Manish Chokhani. I'll toss it back to you, Shireen, and we're going to see you very, very soon.
All right, Nigel, we are going to come back to you and the market forum. Prashant is going to kick things off with Ramdev Agarwal and Manish Chokhani. Stay on with us. Don't go anywhere. That's CNBC TV 18 exclusive coming right up.
Guess what? Portfolios were down by 20 to 25%. So everyone's interested to see where does alpha get generated this year? Also, what are the top themes and what are the contra bets? Because that's going to be rather interesting. A couple of sectors like real estate and IT, they have done absolutely nothing. In fact, stocks are down between 10, 20, even 30% out there. So can some of those ideas come up as contra bets is going to be important. And also marketmen's view. Gold versus equities. Well, we have been talking about various ratios. Gold continues to move up. It's got safety buying as well that we see, safe haven buying. But will equities finally have a better year than gold? That's going to be top of mind because as of now, a lot of investors going by the start that we have seen to 2026, they're getting a little bit jittery. We start markets at around 9 a.m. By around 11 a.m., we've seen numerous times that the markets have been under some pressure. And we have been seeing recoveries from there. But otherwise, 25,500 important on the Nifty. I'm waiting by to hear what our market men have to say, Shireen.
Yes, and you can see our market experts on your screens there, Ramdev Agarwal and Manish Chokhani. They're going to be kicking off the market forum. But, speaking of themes and sectors, question for Ramdev from my side, Nigel, will really be on how this e-commerce, quick commerce story is likely to pan out. That's a big bet that Motilal Oswal has made. They've put in a significant amount of money into Zepto. There seems to now be a lot of regulatory pushback. Of course, as we reported today, a short while ago, that the ministry has nudged quick commerce companies to drop the 10-minute promise from their marketing and branding. So what does Ramdev make of all of this and the likely implications for that big IPO that's awaited Zepto, which is, of course, likely to be one of the big IPOs of 2026? That would certainly be one of the themes that
It's January 2026 and markets are doing what markets do, recalibrating. Indian equities logged their sharpest correction in over 3 months, with benchmark indices adjusting to shifts in foreign flows and global trade dynamics. Foreign investors repositioned significantly through 2025, and the rupee has tested new levels against the dollar. That's the market we're in, one where policy, geopolitics, and flows move as decisively as earnings, where beta is uncertain, but alpha is available for those who know where to look. Which leads to the only question that matters right now. Where is alpha in 2026? This is why we have created this platform for the conversations that shape how India allocates capital, the conversations that happen before they become consensus. Over the next few hours, you will hear from some of the sharpest minds in Indian finance and markets, the veterans from the industry who have turned early conviction into extraordinary wealth, CIOs managing billions who are navigating this exact moment with real capital at stake, and economists and strategists who advise the institutions that move markets. Before we begin, special thanks to our partners, Mirae Asset Mutual Fund, ICICI Prudential Mutual Fund, and associate partner Reliance Industries Limited for believing in this idea from day zero. Let's begin with what matters right now. Markets ahead. Valuations have adjusted, flows have reversed, the macro environment has shifted. The old playbook doesn't work anymore, which means 2026 belongs to investors making conviction calls while others wait for clarity. So where are the risks? Where are the opportunities? To explore that, please welcome Prashant Nair, Executive Editor at CNBC-TV18. And joining him for this conversation, we have Ramdev Agarwal, Chairman and Co-founder, Motilal Oswal Financial Services, and Manish Chokhani, Director at Enam Holdings. Please welcome them with a huge round of applause. Prashant, over to you.
Thanks very much, Shruti, for that. Please. I think we'll get to alpha in just a bit, but I think 2026 has started on a phenomenal note, right? I mean, it's hard to believe it's only, 10, 12 days into this year. 2025, I dare say, seemed like 3 years compressed into one. And these 12 days seemed like, the whole year in that sense. It's the sheer amount of news flow, the news cycle, and every day is new. What we're going to try and do is understand if, it matters for investing, right? At the end of the day, how do you use everything which is being thrown at us in a way which helps us rather than hurts us, right? I want to first put up something which Manish tweeted, and I think it'll come up right here on the screens, which I think perfectly, as they say, a picture is worth 1,000 words. There you go. So there's Tintin, there's Captain, there's Snowy. What a year. Captain, it's only the end of the first week. So, yeah, I mean, I think, Manish, let's start there. I mean, I think that tells the story, doesn't it?
Well, it's thanks to President Trump, right? You wake up every morning and he's made for television. And he's reset all rooms of the game. And we're back to, like in 1980s, we used to watch Hindi movies. It was Aaj Ka Gunda Raj. That seems to be going on.
But has the world changed, Manish? And will it stay changed?
Yeah, the world has fundamentally changed. There's no two ways about it. That what happened after falling of Berlin Wall gave us 25 years of American supremacy, rise of globalization, capital markets, and all of that. And President Trump is clearly reversing that there's no more globalization. We don't want just in time. We want resilient supply chains. We want nearshoring, friendshoring, onshoring. So this move of capital across the world, goods all over the world, is not going to continue forever. And it is now an inflationary world that we're living in. Because you've created these bottlenecks everywhere, and that gives rise to different kinds of asset classes. You've seen, therefore, the rise of gold and silver and stuff like that, because it's really an anti-dollar. What is the next currency that I could be in? It's not connected to equities, but if I have to store it, the older people buy gold and silver, and the youngsters all go and buy Bitcoin or whatever. So there is a change in the playing field. Having said all of that, as equity guys, we learn, we buy businesses, we buy them cheap. And as long as they compound and they make money for you, we'll still be okay. And before we came in, I'll just use a 2-minute example for that today Motilal Oswal's profit and Sanjay's profit at AU is 2,500 odd crores. And if I go back to 2001, Lata will corroborate this, the profit for SBI, which has 25% of India's banking sector, was of this magnitude, 2,500 crores. And today they are going to be north of 80,000 crores. So in a sense, that's the alpha you need to look for. It's not about what happens this year, this quarter. The scale of opportunity is just crazy. I remember buying Bajaj Finance in 2008. Sanjay, the profit was 20 crores. And there'll be a 20,000 crores this year. So it's a country of opportunity, so let's not get diverted by President Trump. He will play his games. The playing field has indeed changed. As long as we recognize the change to inflation assets, I think we should be okay.
As they say, we kind of tend to overestimate the impact of things closer and underestimate things which are far out in the future. But that does not apply here. In a way, you're saying, well, the way if things have fundamentally changed, it'll stay changed. It may not matter that much for how you invest. That's the point you're making, Manish?
But, I mean, think of it like Warren Buffett went through how many cycles, and Ramdevji will speak more about it. But his first wealth was really made in the inflationary era when he bought brands and stuff. And he morphed over time. Towards the end of his career, he was still buying value. He bought Apple very famously at a 15 PBT multiple. He was not betting on a high multiple in a technology stock. But he played the game well enough to come to that as the playing field changed. And he changed his style. But he never gave up his value orientation. Same way, like we always say, I say, if you can buy something that you look out 5 years from now and it looks like a 5 multiple, that means I know the business for 5 years. And at the end of 5 years, if I've bought a 5 multiple stock today, the end of 5 years, I'm expecting the multiple to be somewhere between 15 and 25, which means I'll make 3x to 5x, which is a 24 to 40% kind of CAGR for me, which is good enough. And that basics of investments will never change.
Ramdevji, do come in. Do everything which is happening, Trump and everything which President Trump is throwing at us. Does it change at all? Does it? Do you worry about it in any which way in terms of how you're investing and how you forecast things?
No, I don't think. As far as my investing is concerned, Trump doesn't impact me. Okay, but of course, world will be impacted because the multilateral globalization which was on. I think world is very interdependent. Now, how exactly it will navigate, it will remain interdependent, and actually it will become even more interdependent. But how do you trade between two countries? I think Singapore Prime Minister said very well. He said, whatever Trump does, trade will find its own way. It's like a water. I found that to be the most important kind of thing. So these things keep happening. Of course, I don't think in the very long run, I mean, one side Trump is happening, the other side AI is happening. So I don't know how to figure out which is going to impact how much. So I would feel very happy that I'm in India. I do things which I understand, and we'll find few things in investing. You don't need to have a view. You don't have to view on everything. You need to have a view on 4-5 things. That's it. I think I'll be able to find enough ideas out there.
With all this uncertainty, just one to close that loop, Ramdevji, all the uncertainty, all the macros, everything, etc., which is happening, and if Manish's point is that it's not a short-term thing. I mean, something is fundamentally changed. Does it lead to low? I mean, there will be headwinds to growth, etc. For a risk asset like equities, does it lead to lower multiples? Generally speaking, or no? It should not.
No. See, equity is very exotic, mystical asset class. Okay, equity. I mean, even I am still discovering what is equity. See, equity has a huge power to take a lot of uncertainty in, and yet, entrepreneur, he's the magician. He can navigate all kinds of risk in his own way. So we have to find those entrepreneurs who are able to navigate those things. Whatever his challenge comes, he's able to navigate and deliver me earnings. So if AU is built or any other entities are built, it's not that they didn't have challenges. So new set of challenges will come. But the entrepreneur has that power or magical, competence and determination to sail through all those difficulties and give us the earnings.
Okay, let me ask you something which I don't think either of you want to answer, which is the India-US trade deal. Manish, let me start with you. Will get done in 3 months? It'll take 6? It'll take more than 6? What's your sense?
He said you don't have to have a view on everything, so we don't have a view.
But take a shot at it.
No one knows. I mean, even the man who has to sign it, he might decide to change tomorrow morning. Yeah. So no one can answer that question.
But does that? I mean, how do you think about it? Eventually, it'll get repaired. Maybe it takes a little longer, a little less.
I mean, worst case is the term is 3 years more. So that's the outside limit, right?
3 years.
India and US will be...
3 years was not there in the options. There was only 3 months, 6 months.
No, I mean, two countries like this can't be at loggerheads for long.
Yeah.
But the fact is we don't have too many things we can, hold someone to ransom for, right, unlike China. And therefore, it's getting dragged on until, like I said in the beginning, you're kind of now in a world of a G2 where there are two big bullies and you have to decide, you have to go in one camp. We don't want to go into either camp. And both of them are trying to, push us and prod us to fall into a camp. The better that we just stay out of these games that they're playing. And if it takes long, it's painful for the next 3 months, 6 months, 1 year, and for the companies and the individuals involved. But on a 10, 20-year cycle, I think what we're doing is the right thing, to stand with our position and what we need to do. So I'm not so concerned about how long it takes.
Manish, you have a global investing view as well, because you invest in other markets. And this is also, I mean, it's not so much about the tariff rate, whether this is this or that. I mean, exposure to the US as a percentage of GDP is small. But it's also a time of absolutely radical innovation, right? Across sectors. And that is where does that worry you a little bit, where there are these two countries, US and China, who are kind of pulling away, and everyone else, for the lack of a better way to put it, is kind of sort of falling into the gulf. I hope India is not, and India kind of sort of,
No, it's fair. I've said this for a long time, that you asked him earlier about, do terminal values get affected? Of course they do. It's like, would you now be buying Indian IT services companies at high multiples? You won't, because there is a terminal value to that business. For example, what happened to broadcasting TV versus OTT? You know that there's a multiple which is going to collapse. Any disruption, you know the losers very well. For example, if EVs take over, you know what will happen to ICE engines and so on. So that disruption is certainly damaging for a number of businesses. We don't know the winners as yet. And by losing out in this AI business, forget the valuations, which may be bubble like today, but the business is real, like the internet was real. Now, my hope is that India is a beneficiary of the AI trade, because we use our data sets to find solutions which are unique to us. The way when the internet came, our types of businesses, financial services, for example, really benefited from it. We became a lot more global. We started having clients globally. Our research costs went down. So in the same vein, anyone with organized data sets, which is the next 2-3 year window of opportunity for our Indian companies to organize that. But what lies beyond that is how well we use this to get both efficiency as well as differentiation. So in that context, India is really falling behind in the technology space. But the way China took it as a wake-up call 10 years ago, when the first Trump presidency went hammer and tongs after them, and they realized that we need to stand up and create our own tech and our own markets and our own systems for doing things. I think that's a wake-up call we are going through today. The way it happened when we got hit with the first Pokhran explosions, and the next 2-3 years, actually, India woke up. I mean, the rise of what we did with ISRO and the defense industry really owes its origins to that period. I think this period will create a lot of important companies being born in India out of this need and this realization that we need to play our own game as well.
You think that is happening, that waking up is happening as we speak?
Yes, it is happening.
It is happening. Ramdeji, on this AI question, do you have any thoughts at all in terms of how it impacts? I mean, we heard it became almost a meme towards the end of last year. India is like the anti-AI. But I don't know if that still holds. But any thoughts at all? AI and how that impacts markets, what businesses will change. Manish spoke about IT having a terminal value now. What's your sense?
Yeah, so as far as IT is concerned, what he said is right, that terminal value seems to be, today opinion is that terminal value of Indian IT is gone down what it was considered 5 years back. So clearly that's the impact of AI directly on the sector. But I think like yoga is a technology, you can say. Okay, yoga we discovered, it's a completely Indian stuff. But the worldwide, I think US guys, they use it much more and they benefit more. So like that, AI is discovered in US or China, wherever it is being developed. But we are the fastest and the biggest adopter of AI. And our services company will deliver the highest number of AI agents and things like that. So I think how it's a big development after internet. So how exactly we will evolve and how it will be used in a corporate situation. You see the way GCCs are coming up. It's a bigger phenomenon than even IT revolution. So all the AI agents of the world could be sitting out of India. So it's too early. Let's not call one way or other. Probably we could be benefiting a lot more than what we might be missing out not as a technology originator.
Fair enough. Let's drill it down to some local stuff, markets per se. Manish, you think 26 will be a tough year? I mean, no year is an easy year, but you think it'll be tougher than usual, or what's your sense?
We spoke in Diwali, we spoke in December, so it's not changing because the calendar has changed.
Correct.
It is a tough year. Until earnings cross substantially double digits and come closer to mid-teens, people aren't going to come chase this market. Money has been going already to emerging markets from Korea all the way to Peru and Chile. The anti-US trade in a way has been on already. Metals have been doing well. Hard assets have been doing well. That trade continues. And I said even then that I would expect financials, hard assets, metals, and public sector, especially with the finance minister and the budget day now, a last big resource raising exercise is left is really from the PSUs. So these three would dominate this year in my sense. And if you make a double digit on the index, I'd be very, very happy. I would take it.
Double digit in the index would be a great outcome. And you're saying hard assets, which you've kind of been bullish on, financials and PSUs are three areas. Ramdeji, same sawal aapse. Easy year, tougher than usual year. And where would you generate alpha? Yeah. Which is why we are here.
Yeah, so I think it will be better here because earning cycle is turning for sure. Because I just saw the estimate we cover one of the largest number of companies here, 350 companies. So MO Universe, this quarter is expected to deliver 20% earnings growth. This is after 6 or 7 quarters, we are getting real upturn.
This third quarter,
earnings. Yeah.
20%.
Index itself could be about 8 to 10%, but all 350 companies put together will be about 20% aggregate. So let's see what comes out. And my sense is Q4 will be even better. So I'm very kind of optimistic on the earnings cycle turning up after brief, lull for last 4-5 quarters. And government is also after it. Now government is trying to put in place, slow down in the credit cycle, slow down in the, your credit cost. You are given fiscal benefit, you are given monetary benefit, you are given GST benefit. So government is firing all cylinders to get their normal GDP growth going at 10-11% so they can collect taxes. They're not able to collect tax. You see the tax collection, 2-3%, 4%. So they need to get to 12-14%. So now there is a vested interest of the government to reflect the economy to about 10-12% nominal. Hopefully with 4% inflation, it could be 7 to 8% kind of real GDP growth rate. That GDP growth is better than 7-8% now with nominal GDP growth of 8%, deflator being 0.5%. I think that doesn't fly in India. So I think we are again back to the old style, 7%, 7 plus 4 or something like that. So I'm optimistic that this will happen in next 12 months and which will push up the earning cycle big time. As for the sectors, I think large caps are better chance to beat the market than the mid and small. Second, I think PSUs still have a lot of steam. They are much more reasonably valued than private sector, and earnings growth is almost 2x of private sector. So that looks to be a very interesting category. And I think financials, I think auto will be the star of the year.
So just a couple of things. Autos, two-wheelers, four-wheelers?
I don't know. I think you should buy auto ETF.
An auto ETF. Yeah. Everything in it. And PSUs, you said? PSU financials, PSU banks. You were referring to PSUs generally? Yeah,
I'm not suggesting any sectoral.
Okay.
But PSU as an aggregate vis-a-vis private sector, PSU should do better.
Okay. And within that, any segment?
I think you are led by, PSU is dominated by banks. Banks, clearly. So banks in any case is coming back. So sure. PSU banks led by SBI and all, I think they should do well.
Okay. And capital markets, of course, has been a
that is evergreen for next 25 years, one way.
You leave something for the fund managers.
No, we'll get to that. And I think Sandeep is here and others are here. Ramji, you said government also has a vested interest now to push up growth to collect more taxes.
Yes.
या तो आप जीडीपी बढ़ा सकते हैं या फिर आप टैक्स रेट बढ़ा सकते हैं.
वो टैक्स रेट तो काम नहीं करता है.
See, मैं इसलिए budget is around the corner, so I wanted to just ask you.
Yeah.
Just a framework in terms of how you're thinking about the budget, because there is a revenue shortfall, and I think we'll discuss this with on the macro panel. But just your thoughts.
No, there is no question of raising the taxes, because otherwise they would have not brought down the GST from 28 to 18. It's a budget in itself. So I don't think the direction of government has open the hands. So I don't think they are going back on to raising the taxes. That's not the way to, because what will you tax? If the economy is not growing, any kind of tax rate is no meaning. So first you've got to get the tailwind happening in the economy. And I think it's very simple. I think they had beaten down the credit flow for whatever reason. That must be their inflation control, whatever. Now they got to get it back to 14-15% credit growth. And that will give you 11-12% nominal, and then it's all evergreen.
But do you think we're on that road and we will start to see these?
It looks like. That's what I hear, what the governor is saying, what the SEBI chief is saying, what the broader things which are coming from Delhi. Look at we should not bother too much about what they say, because they can keep saying, but what they do. So what they do is what they've done in last
12 months. Which is stimulate.
125 basis point cut in the interest rate. Credit flow gone up from 8-9% to 10.5%, 11-12%. Then you have the GST cut from 28 to 18. Your tax-free rate has gone from 6 lakhs to 12 lakhs. What more they can do? They can further cut the interest rate by another percentage or so. I think things will happen.
तो कुछ खराब नहीं होगा बजट में, कुछ अच्छा हो सकता है, रामदेव जी.
I think so. We are in the. I don't think government is going to go back till they get their taxation right. Okay. Their interest is to get the taxes from the market. Yeah.
Manish, budget?
No, he's rightly said it. They've already cut your direct taxes. They've already cut your indirect taxes. So there's nothing to look forward to on that side. And the resource raising exercise has to come now from public sector. And if some of those assets go cheap to private hands, like it started in 2002-3 in Vajpayee era, it reignites animal spirits, because private sector is clearly not opening the purse strings because they are a bit uncertain about what's happening in the world as well. So anything to revive animal spirits, whether through privatization or disinvestment or maybe some other PLI type scheme, would be very welcome, because even the labor codes which have come have actually, in a sense, increased the accounting cost for companies. So you need to give a profit fillip to the private sector. Let's see, something comes. The good news is they've demystified the budget. You don't wait with bated breath ki kis pe talwar padegi. Now you look for
your sector, which is commodities and hard assets, right? I mean, they've had a phenomenal year. Yeah. On that front, I mean, on the taxation front, I mean...
Listen, tax I don't honestly think about, because let's first think about making money. Then if we make money...
No, that's what we think. But I think...
No. Look, the beauty of our profession, which we've chosen, is you wake up optimistic every day, looking at the bright side of things. Yes. So I don't wake up worrying and chewing my nails. By and large, everyone in this country, I've said it very often, that if our God had put the GPS off by 5 degrees and we had landed either side of India, we wouldn't be discussing wealth creation. We would be discussing how do we stay alive. So be thankful for where we are. And by and large, the country is going in the right direction. We are in the right age, right space, right time. Things will be better.
That is a nice philosophical sort of, close to the discussion, but I think points well made. I think we can maybe open the floor for a question or two if we have a question from the audience. Anyone, please, if you do, so please stand up, introduce yourself and do ask the question. If you can get a mic to him, please. So behind you.
Thank you so much. So my name is Suresh Gandhi. I am from the healthcare industry, but after leaving healthcare industry, I have moved 15 steps into wealth management industry. And I am also a franchisee holder of Motilal Oswal. So Ramdevji, it's a pleasure meeting you. And likewise, Manishji. And I have been always a fan of CNBC-TV18 and I was sharing a lot of anecdotes about it, but I will share that later privately. While I like the optimistic approach that Manishji has so very well highlighted, and a few of the things that one must keep in mind is that in the morning, when we wake up, we need to keep half a dozen different optimistic ideas afloat. Otherwise, we could go off very badly. But nevertheless, does it bother any of us, or you especially, the wealth creators in this country, that certain factors which come to my mind, and I have just jotted them down in 5 minutes that came to my mind. We talk of disruptions and what Trump is...
if I could just request you, if you could keep it brief, because we want to take a few more questions, please.
While Trump is doing what he would do, causing disruptions all over the world, and perhaps that is good for USA. But as a country, what are we doing? What disruptions are we doing? And does it not bother us that without some kind of disruptions, we would end up being nowhere in 5 years, 10 years? We might generate alpha, but for the next generation, we will have a very poor story to tell. There is hardly any research. There is hardly any innovation or beating in AI or being a leader in AI. There is hardly any cost advantage. The social unrest is humongous.
Sir, can I ask them to respond? I think we got the gist of your question. Manish, you want to take it, please?
There are 10 other points.
Please.
Sureji, I just know from 35 years, I could always make a macro bear case for India. And I know for 35 years, we just focused on buying the right entrepreneurs at the right price and generating wealth for ourselves. And by and large, has your living improved or not improved? Has all your standards of whatever you did, whether your house, your car, your road, well, I can't say the roads in Bombay, but generally...
road anywhere you can't
Coastal
say.
road to aa gayi na, but
Coastal road,
so, but you can always see glass full or glass half empty. It depends. And you said you're from the wellness industry. If you choose to be looking at life with gratitude and happiness, you will stay well also. And if you look at things with a pessimistic outlook, you'll be pessimistic. I can share, my son is 32. He spends half his time now meeting technocrats and scientific talent, and we ourselves were fortunate to create a business based on that. The creative instinct of the youngsters in India is not dead. You and I may feel old. You go to IIT Madras, go to IIT Bombay, see what is happening there. We have an investment in Agnikul, it's like one of the top space rocket launching companies of India. He's created a rocket which goes and comes back the way Elon Musk has done, but at a fraction of the price, maybe for the SME sector. So to just dismiss that there's nothing happening in our country is to do with our lack of seeing or knowing what is there. There is stuff happening. Even if you looked at China 10 years ago, we used to famously say, we know software, we know IT, they don't know anything. From where did Tencent and Alibaba come out? From where did BYD come out? It came out from that same country, which we said is full of robotic people. So yahan bhi hoga, just have faith, have patience.
But there are no any green shoots that one can see.
It will come to you at 50p when the P comes and sells it to you in the IPO.
Thank you very much, sir.
Okay,
any more, please? Surubi, go on.
Fantastic conversation, gentlemen. So in the spirit of optimism, if I could ask, and Prashant was talking about taxation and Manish mentioned that the bulk of it is done, indirect and direct tax. But since we're being optimistic, let's talk about capital gains. And Manish also made that point, right? That jab gain hoga, uske baad tax ke bare mein dekhenge. But say if the government were to consider rolling back to 10% LTCG, will it really help the market? Will it really change anything? or will it be a bullet wasted in an environment where there's anyway too much flux?
I don't want to hog the. You want to go?
See, as he said, the 15 or 10 depends on how much money you made. If you don't make money, then how does it matter? And actually, I don't think people really complain about 15%. Also, we also need.
Oh,
So
abhi 12 and a half hai.
No, see, it will definitely be a cent.
Yeah, 15 पे हाँ मत कहना.
I think it's 15. No?
They give ideas then. if
So
it's
she was saying
15.
from 12 and a half, if it goes down to 10%.
I don't see it is sentiment booster for sure, but I don't think it's a game changer. No way.
At a time when you spoke about government revenues obviously being under pressure, Manish, just if you want to add.
No. Look, this capital gains is a red herring, and it creates a friction for everybody, including for the foreigners, because the way they have to do their fund accounting with accounting for NAV calculation with taxes implied when people come in and out is just wasting time. If they would just increase the STT on this, they would solve Jane Street and they would solve for FIIs, and you don't have taxation problems at all. But someday something will happen. But to answer your short point, the capital gains is a net deduction from your DCF, right? So your terminal value will go up to that extent marginally. But like he rightly said, I'd rather make 25% gain and pay a 12.5% tax than make a 12% gain and pay a 10% tax. So if we can get the animal spirits up for the entrepreneurs, let's focus on that. We guys are all derivatives. We ride behind people like Sanjay who actually build business, who build wealth. We are just buying 2%, 5% of their companies and riding with them. Let's get their animal spirits up. I think if we get that from the budget, I think we would be very happy with that.
And that's so beautifully put, Manish. Thank you very much, both of you, gentlemen, for a really enriching conversation in our attempt at finding alpha in 2026. Really appreciate it. Thank you very much. Ramdev ji, please stay on. No.
Thank you, gentlemen, for those insights.
AU Bank back in 2008, March of 2008. They put in 20 crores at a valuation of about 50 odd crores at that point.
30 crores. सर इतने महंगा देते नहीं थे यार.
अच्छा, तो ठीक है. So and then they stayed invested. They put in more money. I think in 2010.
10.
There was, and then of course, I mean, in a phased way, they sold their stake.
Yeah.
The final exit value, market cap, when they sold was about 5,000 crores. So
Yeah.
it's been a 100-bagger AU Bank for Motilal Oswal private equity.
Yeah.
I know Ramdev is coming.
Yeah.
Now Ramdev is the second thing, right? So Motilal Oswal as a firm still owns about 77 odd lakh shares.
70 lakhs.
Yeah, 77, 78 lakh shares. And there he's not made 100x, he's only made 33x in the last 11 years and he's complaining.
No, I'm not complaining. I just wanted to keep the record straight. I have not made 100x.
Well, I think he will. And congratulations, you've got the universal license. So I think the 100x is coming, Ramdevji.
Yeah, sure.
What we aim to...
So, I think, because you are covering the story, but, just 2 minutes on it.
Please.
So when I came in Mumbai in 2007, and I was looking for a private equity or a private capital, and, I was being supported by HDFC Bank. But then I met Ramdevji, I think 2007 September onwards, right? And Vishal and of course Ramdevji. Ramdevji se baad mein mila tha, Vishal se pehle mila. And from there today, it's good now. 20 years, more or less 19, 20 years, right? And still when Ramdevji speak to me about the company, the future, the growth, the India story, must be hearing so much. I think it always inspires me, For me, it's not the way Ramdevji would have earned money or would have created wealth. I think his company, his Sangat, which has inspired me so much that if people ask me that who inspires you to build company or to build institution, I think one man, which is Ramdevji. So thank you so much, Ramdevji, for doing me all these things for over the years.
He inspires us all. I mean, I have to say.
He is pure. He is so natural that sometimes, you are in such a difficult, positioning mindset. But once you meet Ramdevji, it looks like, why you are so much depressed, Just go and play the inning.
Yeah. What we aim to do here is try and ask Ramdevji how he built his conviction. And I mean, the motto at Motilal Oswal is buy right, sit tight. And I think you've done both with AU Bank. So what can we learn from the journey, and how to, as investors, how do you kind of find these kind of tremendous wealth creating ideas? And of course, we'll ask Sanjay how he did it. So I'm actually just here to facilitate the conversation. As a conversation aimed, we thought of it as a conversation between Ramdevji and Sanjay. Correct. Let me just kick this off. Sanjay, let me ask you this. When did the idea come? I mean, what was the genesis? Because your family was not in business, right? I mean, you're a first-time entrepreneur in that sense.
Yeah. So Prashant, I'm a product of 90s, I done my chartered accountancy in 95, and that time era was very different, and the only silver lining was that India was opening up, there were some sectors which were given the private license, and at that time only the HDFC Bank of the world came in picture, right? And being a chartered accountant, I figured out that I don't want to do any normal practice and all those things. But Jaipur, was never inspiring you or pushing you to do something great, Somehow, I would have done around 10 odd businesses, in those days, right from export to even a truck company and whatever, right? But finally, I figured out that my own knowledge or my own comfort is more around the building the businesses around what is your, finance or maybe investment banking and all those things. So I started with my own HNI help, and subsequently, got with HDFC Bank, the famous partnership, which I always say that, I'm a product of HDFC Bank partnership, and they inspired me a lot. When I started meeting their leadership and, figuring out that their knowledge and my knowledge is same. So, the ability to think big.
That was in 2003.
2008, right?
Yeah.
And I met everybody except Aditya Puri Saab till 2008, and with Paresh and everybody. And those people really inspired me that whatever they have as a character, as a personality, as a risk manager, product manager, distribution franchise, I also have, but I'm not getting a platform, right? And where I met Ramdevji, and the team, of course, the first is Vishal Tulsian, and from there onwards, and when they started believing in me, because it's not about putting 10 crore in your company, it's about believing and supporting you, and I was coming from nowhere, At that time, 2008, it was one product, one state, one lender. That was the company, right? That was not an NBFC. I think when Ramdevji put the money, then we became NBFC. And then, now you know the story. So I think one thing led to another, kept the patients always in mind to really, be around that, so all those things. So
and Ramdevji, I think always used to say the next HDFC Bank. HDFC Bank was a big winner for him back in the day, and he always used to say the next HDFC Bank, and I think he found that in you. Ramdevji, tell us a little bit about your first impressions and what really got you excited about AU and Sanjay.
Yeah, so we had set up this first private equity firm, private equity company, and we had about 400-500 crores to invest to 10-12 companies. So one of the thought process for me was value migration from public sector to private sector. So I said, and that time HDFC Bank had already become somewhat. So we said, I told Vishal, why don't we look at some budding private sector lending companies? So get me few small ones, because we were giving 30-40 crores, so we couldn't have got big one. So we're looking for this thing, but profitable. Okay, so in 1 week's time, they bring in front of me Sanjay. Okay, now Sanjay, I said, I think they're making about 2 or 3 crores profit.
Yeah.
2 crores, yeah. So I said, so how much, what exactly you do? So they said they're onward lender of HDFC. So we had great respect for HDFC. So he said they have got 200 crore line from them.
Yeah.
I said, we'll check with them whether you actually got 200 crores or not. Yes. If Aditya Puri has given 200 crores, we'll definitely give you 20 crores. 20 crores. That was the total due diligence.
I think it was not me, he got the comfort. The comfort was Aditya Puri.
No, if somebody has, how do you check whether this guy is good or not?
Yeah.
So he's a chartered accountant, good looking, very energetic, very nice, everything. But whether he has the business sense or not, if Aditya Puri is given 200 crores, 20 crores hum pakka denge. And the deal got done.
That was line of credit. I mean,
it was a partnership model,
okay.
right? And where the first loss basis,
right.
outstanding was around 400 crores,
right?
Yeah. So
no, but Ramdev, there would have been other companies where HDFC Bank would have had kind of these kind of arrangements.
But we had only this proposal in front of us. Don't forget, he's a chartered accountant.
Yes.
He's a good, robust chartered accountant from Jaipur. So, I mean, we liked him. We liked the whole idea that he has been already successful and he's profitable. See, for me, it was very important that he was profitable. Yeah. And then I think the one led to other, we negotiated.
But Ramdev, let me, so, in 2012-13, I still remember, and you were in different mood that time. And he called me up and said, Sanjay, yaar, banking license mil jaye na, to main tere ko leke dunga. So he actually quoted me that you should run a bank. And at that time, there was no license, even a guidelines or whatever, And when I got the license in 2015, I called up, sir, sir, aapki ichha puri ho rahi hai. So I don't know how, he has some linkage with me. I don't know what, Prashant, honestly, that he has some view on us and he can actually read our future. If you go back and see his video on us in 2009, when we celebrated this investment, what he has said at that time in Jaipur, and many people now when they see the video, they say, how come Ramdev ji knows you so well that, I think he quoted that, in 2009, that one of the asset class, one of the asset which will grow in Jaipur, in next 15 years would be AU, So I think, I don't know how, from where, you always have some comment on us, whether it's koi Hanuman ji ka kuch hai aap pe ya
See, no. It is the tailwind of the private sector banking because value migration was done, and they are competent guys. They were actually conducting so well. So I was very clear that there will be many more HDFCs will be born, and a lot of guys that tried to be next HDFC, and nobody kind of made it. In fact, the most successful possible bank right from ground up is going to be AU, and I had been so. See, one of the things he said, I will never give unsecured loan in India. That was one of the promise of yours.
Yes.
So they never, see, a lot of companies, banks, they suffered because of this unsecured loan, the MFI part of their own book. So fortunately, they were not heavily into this right from beginning. So they had a very good risk management. And when I visited their office in 2008, I found their office to be run tighter than my office, and I was always proud of my office. So I said, "Ye bande to bahut sahi hain."
Tighter means?
Tighter means you could see, at 11 o'clock people are silently sitting. You just feel, whether
it's a well-run operation.
Well-run operations or not, or it's a loose. Aisa kuch nahi. It was small operation, and yet it was very professional. It's from 1985. So I have seen hundreds of companies badly run, very well run, world class. I've seen all of them. I've seen Infosys from 95 onwards. So those things help you understand whether there is something better than special, because you're just talking about 50-60 crore worth of company. Total market cap to be about 70 crores.
Right.
So these other things, when you look at a company, what is the option value you are paying for all this? You're getting a terrific entrepreneur, terrific future. The runway is very large because this country is going to have 14 to 15% credit growth compounded for next 100 years. In that, you are starting with literally nothing, some 100, 200 crores. So Runway is massive. Size of opportunity is very large. Business is reasonably good. It's not like Nestle or Lever, but 18, 20%, 16, 18%. So it's a damn good. But you can deploy a lot of capital. You can deploy 5 lakh crores, 10 lakh crores. But there needs to be a discipline. So most important thing is, how do you handle capital? How do you, when lend, how do you get it back? It is not an easy trade. I cannot do it what he can do. Because when we invest in equities, we know it can go to zero. And we allow it to go to zero, and many times it goes to zero. But this guy, they cannot afford to do that. When they lend, they want everything back. थोड़ा सा पठानी कार्यक्रम भी हो. So
इतना खराब भी नहीं है सर.
नहीं इतना खराब भी नहीं, but you know, being good lender needs to be very tough. Even if you see Aditya Puri, he's not a very soft guy. He's a you got to be strong. Even physically, you got to be strong, and he was. So we said, let's take a bet on
collections are not a problem. Sanjay, but has Ramdev ji been a capital provider, or he has been a he's provided guidance, mentorship? It's more of a partnership. I mean, how do you?
No. I don't think that Ramdev ji, provided with the capital. Honestly, it was more of Vishal's fund and all those things. I think Ramdev ji always, inspired me a lot. In terms of his approach towards life, his approach towards building the institution, his approach to think, bigger, larger, beyond today. All that came because I never educated from the business school, right? I'm a chartered accountant only from Jaipur. So how come you can relate that in 50 years, you can be a largest bank or maybe a top 3 banks of the country?
So he gave you, Ramdev ji ne aapko sapne dikhaye aur aapke kuch targets the?
No, Prashant ji, it was not about dreaming. It's about...
No, in terms of what is possible.
No.
Yeah.
I think he's very natural, honestly, right? Like what he was saying in the earlier discussion that, be optimistic, there will be many noises, but you don't want to be noises, be on your job, I think his maybe would have given me 5 ideas, but those ideas actually built it, Sure. Now it's my duty to not to have 50 ideas from him, right? He will give you 5 ideas and build yourself another 45. So I think for me, he's the first guru to me in terms of not building as a bank, right? Building as an institution, building as a personality, character, Sure. Governance. I still remember that because I'm Jaipur ke chartered accountant the, in 90s, chartered accountant would do a lot of things which is not correct in my opinion. But in 2010, he told me that, Sanjay, don't waste your time on taxations. Don't waste your time on the tax people. It's a waste of your time. Just pay your tax. Pay 1 rupee more so that they are not coming to your office, right? And we are now 17, 18 years, Actually, I don't even waste a minute on my tax status, So I think these were the things where he was pushing me to be focused on business, good governance, building the team, think big, think beyond you, And that is why, Prashant, and with the full blessing of Ramdev ji that, in my last 9 years, our balance sheet has now gone 10 times, in spite of so many challenges, right from, the COVID or the bank crisis, NBFC crisis, the interest rate high, how the last 9 years would have been, right? But we just kept on our resilience, focus, execution, right? And we are now, the largest SFB, the only one we got, the universal. And now from here in next 15 years, me and Ramdev ji were chatting the other day that even if you grow by 20% year on year, we would be touching what today the ICCI is, So what we have done in last 20 years in the partnership, we have created the belief that we can do it.
Yeah. I mean, I remember the IPO when it came at 10,000 odd crore valuation, and it was an expensive issue.
Five price to book.
Yeah. 5 and
got listed as 6.5, 7 book.
Yeah.
70 or 10,000, and now of course market cap is 75,000 crores. And now you've given us it can be an ICICI. I mean,
it has to be bigger than them, honestly.
Yeah.
Because, let's be honest here, right? HDFC Bank never had an advantage of AI. I think they never had an advantage of their own, they didn't have any role model, right? I have this HDFC Bank in my front, right?
Right.
I have more technology. I have more ambitious people with me. I have bigger economy, right? So my aim cannot be only HDFC Bank, to be honest. In my next 25 years, it can be bigger than that also. I think the challenge is not opportunity. The challenge is how mentally you are solid enough to take that scale. Or to remain in that corridor that you will get right. So I think my belief is that in next 15-20 years, I know that I'll not be there, but this institution will become big, and you will all people be really proud of what we have created in last 20-30 years. So
that's a round of applause for Sanjay. I think that's a phenomenally well put. Yes. Story and of course ambition.
And you were talking about AI, sir? Yeah. Because some subjects maybe not be going deep, but at bank level, Prashant, I am seeing that because for the scale, HDFC would have done much hard work. Now hard work can be replaced by AI. You will need people, right? But you can't put energy. You can't put them that they have to do everyday hard work to build a next HDFC Bank, right? In my opinion, we will create on a 50% effort bigger bank than HDFC Bank in next 25 years because of the tech support.
Which is now available, which is not there back then.
You can't even imagine what kind of AI is doing in the sense of making the life easy. The language has become, no matter to what. As of now, if I want to build a South franchise, I need to understand 4 languages. Now I don't have to understand any language because AI is talking to the customer, right? So where that capability was 25 years back.
Yeah.
So when I'm deep in Tamil Nadu, I have a support of AI-led communication, right? So I think these small things are really helping me as a CEO to think bigger, scalable, and that too in control.
Yeah.
It is not that, when we are building up, there are many gaps will come in, right? So I think, in my opinion, the technology will actually fast forward the entire scale building mindset.
I think Manish makes that point often that maybe in terms of adopters, the biggest will be financials and banks.
Yeah.
Because you have the data, you have the...
I have one question, Sanjay.
Yeah.
What the regulator is doing is that whatever is the founder bankers, like Ms. Kotak, and so they are being, at certain period of time, they are being superannuated and they want the team to be in place to take it forward, the journey.
Correct.
Okay. So is AU, since it is a first generation entrepreneur and founder, do you have, well before you are being asked to step down, do you have a better team than you, ready to take over?
So, sir, I think if you ask me, banks are public platform, and I completely in sync with the regulator's view that beyond a point, a promoter or a CEO should not continue because it can create a risk. It's not about Sanjay Agrawal or maybe any other name. It's about the system in place. So, and then this my duty, or any CEO duty to create a second line succession, because in the end, it's not about 15 years. Maybe after 30 years also, when I get retired, somebody has to take care of that, right? So I think that is completely in focus. And regulator also pushes us to create 2 EDs or deputy CEOs, deputy managing director, in order to really build this, the sustainability around leadership, And Ramdevji, for me, being a first generation entrepreneur, I strongly believe that, it's not about you, it's not about me to build a business. It's about how better I can visualize that, how it will run beyond me, And banks are meant not only for 30, 40, 100 years, I have seen a bank for 400 years, So why can't we create an institution which can last, even, when I come back in this earth, maybe, I just joined AU Bank as an employee, right? So I think that's the whole idea, to build a institution which can last for not for only centuries, for many decades, not for decades, many centuries, So
Ramji, from viewers,
it's there, sir. So in short, it's there, and we work on an everyday basis.
Yeah, Ramji, for an investor who's watching, right? What is the takeaway? How do you spot an AU? Not everyone has the access that you have, or the team that you have. What are the 2 or 3, especially in financials? Because it's a space littered with accidents, and you yourself said the most important thing is return of capital. That is that you can't go wrong there. So what would you tell viewers who are watching?
So now actually opportunity is not only among the lenders, but now the much bigger opportunity is opened up in the non-lenders. That is the capital market. Whether it is AMC, whether it is wealth management, they're just about to start it. So fortunately, they are not lending type. Here you have you need a platform where there is no capital adequacy so far, and I mean with 10,000 with 1,000 crore capital, you can manage maybe 10 lakh crores or 20 lakh crores. So what is required is to create a competent team and competent distribution to manage assets, because the wealth generation in the country, I mean, just to give you some numbers, in last 20 years, the total savings is about $12-13 trillion in India. If you add up all 20 years. Next 20 years will be, hold your breath, it will be more like $50 trillion. Just the savings. Mark to market on top will be another. So we're talking about $100 trillion flowing in here. We don't need anybody's money now. I mean, there's enough money from the domestic savings coming into the capital market. Now that capital needs to be managed by wealth managers, asset managers, intermediaries, all sorts of things. Now, can we find one emerging platform, whether it is a wealth management, whether it is asset management, and hundreds of them will come. But can you find a Sanjay Agarwal in that vehicle and maybe seed, you know? So
you don't have to look for a Sanjay Agarwal in a bank. You can look for...
No, bank to I'm already invested.
Bank to hai.
Yeah.
So,
now he will set up insurance, AMC, wealth management, everything he's going to do it.
Yeah.
And that will come free of cost to us. Yeah.
But Prashant, my own understanding, sir, is this, that last 5-7 years, you know, and the credit goes to all you people that you put so much money into the new, you know, energy. But nowadays people are really want to build a business which can actually create a value. So they are not looking, you know, they're creating a value from balance sheet than a P&L, right? So you will find many entrepreneurs, you know, but, you know, somehow you have to train them. Somehow you have to, you know, make them understand that it is not a 1 year, 2 year, 5 year story. You want to really create a wealth, it has to be at least 20 years, you know, have patience, you know, have better governance, better transparency, honesty, and you have to delink yourself with the company, you know. What generally people make mistake that, you know, they want to own everything, you know, and then they just mess up, right? So, but I think there's a lot more opportunity, more people than what at our time, you know, in my opinion. So, but you have to train them, right?
One thing I want to say, you know, we have to find people who have done first round of success. The whole entrepreneurship or success story of any entrepreneur, any in the world, it is success built on success. It's a series of success. It's not one. Now, AU Bank has come this far and they just got the actual universal license. So that is one of the reward for success. Now, how they use that universal license to go to the next stage. So it is a, you know, continuous build-up. So that's what I have seen in my 30 years of entrepreneurship, that success builds success. It's not that right from day one, you know what is going to be your future. Nobody knows.
Yeah. Ramdev sir, in Jaipur, when you invested in 2008, Prashant, you were the only NBFC.
Yeah.
Now, the North NBFC Adda is Jaipur. You'll have 200 NBFC. And no, the ripple effect is that every NBFC is paying tax.
Yeah.
You know, I think the success is only not limited to you. It's entire society, even government benefits from the whole success of any entrepreneur because it inspires so many people, right?
Yeah.
So I think the only point I want to ask Ramdev ji, and then I'm struggling with that, if India want to get a scale, you know, which we are talking about, you know, how we are educating people in terms of building businesses, you know, and building the resilience, building the mindset, you know. I found that Indian education system don't give us a business school, you know, like where we really want to understand the entrepreneurship, building the business, understanding the business.
Programs like this.
Yeah. Program like this? Yeah.
No.
But do you think like American system of building?
No. Best. See, entrepreneurs are kind of the guys who want to work for themselves. That is what is the real trade. Like you and we both decided to work for ourselves.
Correct.
Whether we are going to become big or not, that is a different thing.
Correct.
So fundamentally, do you want to work for somebody or do you want to work for yourself?
Correct.
Once that determination is there, then that school is your own kind of a country, your own place where you want to do it. I think
I was thinking to propose you, let's start a business school.
I don't think
that's an idea.
Business school. In fact, business school. You go to business school. They are looking for, they will not attend your lecture if it is not going to give them credit.
Yes.
They want only placements,
Yes.
nothing else.
Okay.
So entrepreneurs are not born in business school. In fact, it is born more in Chartered Accounting Institute.
I think this is such a lovely conversation and we could go on, but I think this is, Ramduji has a further appointment, so he's got a hard stop as well. Thanks both of you for being here. Sanjay, what a
Pleasure to be with Ramdevji.
what a wonderful entrepreneurship journey. And I think you've given us targets bigger than HDFC Bank in the next 20, 25 years. And why not, right? Absolutely.
I'm giving target to my team.
Yeah. And Ramdev, thank you so much for being a guiding light to AU and, of course, all of us. And thank you for being here. Really appreciate it. Thank you.
Thank you.
Nice 30 minutes or so. If I had to ask you a question by March 31st, what do you think? The market's going to be higher from here? Yeah? India will win the T20 World Cup as well? What do you think? Lata is keen on that. So Lata is feeling optimistic today. India wins the World Cup and the Nifty is up 5 to 6% from here. What do you think, Lata? And the second one? Well, I think on that note, we could, Nimesh, get to our panelists.
So, first of all, thank you very much, Sandeep, Tahir, Nilesh. Thank you for joining us. It's been a tough year, so to speak, calendar year 25, I mean. And again, the start has not been that great for calendar year 26 as well. To start with, a broad, looking back at 25 and what to expect in 26. Sandeep, if you want to start.
So obviously, looking back, difficult 2025.
Yeah. Okay.
And I see fragile 2026, not only for India, for global. The challenge which I see in 2026 is not about India. The risk which we are referring is not related to India. Worry is about US market because extraordinary complacency is there. And I see that's one of the big risks of 2026, where developed market will correct and they can correct sharply. And I'm taking a big call. This year belongs to P contraction. Global P will contract. And this is the thesis which is based on some of the analytics which we do. And the biggest risk which I see coming is the rise of dollar index, because it's a consensus trade among all the strategists and the economists globally. The de-dollarization thesis is which did, obviously dollar has depreciated last year. I think long-term perspective, I also believe that we are in structural downtrend for dollar. But from a near-term and medium-term perspective, that's the risk which I see, which means a lot of things can correct sharply. And the trade which we are seeing, everybody has seen a very big move in the metals globally. I think that cycle is also peaking out. Now, when I say from a longer-term perspective, we are extremely bullish on commodity. We have been very early to talk about that money will move towards real economy from leverage economy. That's a thesis for few decades. That's the thesis which I have been saying right from 2018-19. This is from 2020, this period will start. But from a near-term perspective, we have seen extraordinary spike happening. And I think it's a euphoric move. I will not call it a bubble. I will not call it a maniac phase. It's a euphoric phase, which means the correction is around the corner. It's not happened yet, but this is a worry which we have.
Sandeep, you gave us a headline that 26 will be a year of PE contraction.
Yeah.
Tahir, if you want to give a headline to us, what is your broad outlook for 26? Mean reversion is something that you're looking at?
I think so. I mean, Nimish, the 2025 has been a unique year in many ways. We've seen 125 basis points of interest rate decline. We've seen a lot of money come into the market, especially from domestic sources. Yet the markets have not performed actually. And quite a number of things have actually, worked in a very linear manner over the last 2-3 years, especially after COVID. And therefore, it's quite likely that in many ways we are set up for a mean reversion in many things.
Yeah.
I mean, everything from the point of view of the dollar, as you mentioned, to let's say even our own earnings trajectory. I mean, it has been poor. Can we probably improve in the next year or so? Can we probably see our underperformance relative to many of the emerging markets? We've seen significant amount of underperformance in the last 1 year. Can that mean revert? Can we see mean reversion in the global markets, as he indicated, that the whole AI trade, which is dominated and led to almost a bubble kind of scenario developing. So in many ways, I think this is what we have to probably prepare ourselves for, and I think we'll have to be a lot more astute. Quite a number of the themes that we always swore by, we still swear by, and we've, as long-term investors, we've looked at those themes as things which can probably compound over a period of time. Did very well in the last 2-3 years, but I've been at the receiving end of things in the last 6, 8, 9 months. And
I'll ask you about themes and how are you?
Yeah, so I think in many ways, mean reversion is therefore the order of the day.
Okay, all right, Nilesh, let me get you in then. That's an interesting couple of calls that we've got. Peeking out of the mother market probably, and the dollar index that we were getting used to slipping, maybe it's bottoming out, and mean reversion, as Tahir said as well. But Nilesh, how do you view it? 2025 was a very, very tricky year.
Yeah.
Going by the headlines, we should have had a rocking year. That wasn't to be. How's 2026? And what's the big theme or the big call that you're taking for 2026?
Yeah, I mean, looking and equities looking from 1 year lens may not be most appropriate, but
Okay.
You're right. I mean, all of us know 2025 was tough. But if you look at the scorecard, Nifty had 10 consecutive year of positive returns, green. Even in COVID year, in the calendar year basis, it was positive, which has never happened in the history of any developed or emerging markets. So to see in the 25 returns in context of what happened in very strong market in 2023 and 24. And I think there were 3 headwinds which caused correction over the last 15, 18 months, and all three are receding, in fact, turning favorable. One is related to macro environment, both globally and domestic. Then related earnings momentum, which also slowed down. And of course, the valuation premium also. Valuations were high about 15, 18 months back. So on macros, all of us know there has been massive sort of turnaround or stimulus, both from the fiscal side and monetary engine has been firing. We have income tax cuts, more money in the hands of people. We have interest rates reduction by 125 basis point. Will full impact, you'll see it. And of course, from the monetary side, again, massive, apart from the reduction in interest rates, injection of liquidity, etc. So it will take a bit of time, but we'll see earnings moving. Again, retracing back. Last 2 years, earning growth has been in single digit, low single digit, in fact. We see it moving over the next couple of years to more like low teens, etc.
Oh.
So in that context, I think the view is positive, constructive. Of course, from a macro construct, the only thing which is sort of missing is what's happening on the trade part. But apart from that, we have very strong flows. We have reversion in the earnings momentum. So I think 1 year again is difficult to predict in equities, but next few years should be pretty solid. Only thing I would like to say is if you're looking for steady long-term returns, then this is a good sort of market. But however, if you're looking for quick and easy money, I think that era may not be sort of what we saw in 23 and 24 may rightfully pause here.
Okay, all right. Tahir, I want to come across to you on that. The problem is nominal GDP. That's still not in double digits, which is an issue with regard to earnings. Do you think by the end of this year, actually, we're getting to a bit of a deflationary scenario and, inflation's virtually zilch? Do Do you think by the end of this year, we gradually get towards that double-digit normal GDP growth, maybe early teens as well, and maybe inflation suddenly starts perking up a little bit? 12 months down the line, do you think inflation will at least be 3-4% or thereabouts?
I would love to have that actually, Nigel. In fact, again, that is reinforcing the whole mean reversion. We've seen very low inflation. Probably very low inflation also is not something which is very comfortable for India because top line growths are determined by nominal GDP, and that doesn't help beyond a particular point. I think the setup is for if not in the early part of the year, but probably towards the end of next year or maybe same time, 2027, we might be talking about the negative base effects of inflation actually. And we keeping in mind things like oil prices and the setups which are happening globally on geopolitics, etc., commodity prices starting to inch up. It's quite a possibility that we get some inflation. And it'll not necessarily be bad. I think that'll be helpful, as you rightly said, that this will assist some part of it will solve the problem of top line growth. I mean, we've got, I think, some 20 quarters of single digit or low double digit top line growths. Even post-COVID, actually, if you go to see, we got some very robust earnings growth, but quite a lot of it was supported by margin expansion. Top line growth has actually struggled because aggregate demand has been somewhat weaker. I mean, we've had that K-shaped recovery and all that. And so therefore, it is not that everything has been kind of, contributing. So I think, can we get a little more top line? Can we get margins becoming a little more subdued, yet delivering some reasonably decent early double-digit earnings growth? I think that's a possibility, helped by some extra inflation, should really be something which we should look forward to.
Sandeep, to take your point forward on PE contraction, you believe that it's a top for NVIDIA. But looking at India as well, we've already seen the EMS companies, a lot of the consumer names which are trading at 70, 80, 100 PE, they've started correcting now. First, your thoughts on those sectors in India? Would it be a complete avoid for you? And maybe then I can ask the same to the other panelists as well.
So Nimish, let's understand first, when we say PE contraction, when we say why we are saying PE contraction, okay? Because we are seeing the global risk appetite has peaked out, it started shrinking,
sure.
Okay? And with a lag effect, you will realize, this is what happened in July 2024, and people didn't realize. After 6-8 months, you realize the pain which you saw. Yeah. I see something similar unfolding in the developed market and particularly in the US market, okay? Yeah. And I'm not talking about the broader US market because Russell 2000 has not done much. Yeah. It's all about that Magnificent Seven. So, and obviously the very large portion of money was shifted there. And because of that, a new age bubble or boom, I will still not call it bubble. Okay. Sure. I still call it, this is a euphoric phase which we are seeing. Bubble characteristic is still not there. So it may take some more years before you reach that territory. Right. With that background is a PE contraction. Now, obviously, if that is the case, then what is the byproduct of that? Which means growth will underperform and value will outperform. That's a one simple conclusion if you can draw.
Is the way you're approaching 26 now? You're shifting towards value stocks?
Yeah, we are in that direction. And some of the new age company or the space which you highlighted, we don't have when we never participated in these names. And we think this is the beginning of PE contraction. This is not the start of the or it's a bottoming. A lot of people are trying to do bottom fishing. My call is not India. My call is global.
Okay.
If global PE will shrink for all new age company, then you will see a much bigger damage happening in India also, because bubble is here because of low float and extraordinary valuation and limited supply. People have participated.
Sandeep, let me just drive that point home a little bit more. If you're given an option to buy, say, an EMS company at 50-60 PE, or maybe a consumer staples company, which has corrected from the top, but is trading at, say, 50-55 PE. Which one would you go in for?
Or you'll go for the PSU, which are trading at sub 10 PE.
So if I have to compare a like-to-like on PE basis, I will go for staple company because some of these companies are trading in neglected zone. They have corrected a lot, and given the GST benefit and the consumption focus on the government, I think this is the area where I will, if I have to buy expensive, then I'll buy staple over buying some of these names which 4-5% margins does not make any business sense.
Right.
Ignored as well.
Nilesh, your thoughts on the broader markets. Why I'm saying is because there are a lot of investors who, through your mutual funds, have invested into small and mid caps. The headline number last year doesn't show up the real picture. The mid cap index, small cap index have been flat to single digit gains. But the pain has been really very hard in the individual names, right? Stocks are down 30, 40, 50%. From a viewer perspective, is the correction done in the broader market names? And would you be encouraging a lot of investors to now look at, again, small and mid-cap funds?
Yeah, see, fundamentally, I would say that one is just a backdrop, the small and mid-cap, the character composition, the scale of opportunity, and the choice of business has changed dramatically over the last 5 years. And the reasons for that is threefold. You had more than 300 plus very large IPOs, $1 billion plus. Then you also have formalization of the economy, typically benefits the smaller businesses. And also flows of money. Flow of money was almost 50% towards this category. But the scale has changed so dramatically that there are many businesses which are large businesses. They are sector leaders. They don't get space in classification of large caps. Some of them don't get any in mid caps. Just to put a number in context, the largest mid cap companies today north of 1 lakh crore. It was 1/4 5 years back, and it was 1/7 a decade back. Right. And same goes with the cohorts of these. So what I would like to say is the opportunity size and the quality and the nature and the characteristics of the business has increased so much that there is enough and more to identify, even if 50-60% of that space is expensive. That's on a very generic basis, because the conceptually that valuation risk is only for small and mid caps. I would not buy that. Even if you look at large caps in this correction, almost 40% of large caps have corrected by more than 20% from the all-time highs. We have a retail company which has fallen by 50, almost half of it, and many power utilities 30-40%. Now coming to so in that context, I would say that it's important to have enough and more dose of small and mid caps, provided they are good quality businesses, they are sector leader, they have scale. And there is enough and more opportunities on that space. That said, this correction, of course, you are right, because it has taken some of the froth in that space, because 23 and 24, many businesses moved too fast, too soon on valuation. One has to avoid that. Okay. If I just put the context of the overall valuation, almost half of the market was at more than one standard deviation about 15 months back. Today it is 1/3. So we have much more choice. Let's say we cover about 700 odd companies. Even if 60-70% is expensive, there's enough and more to pick and choose. So I will be very positive on that space, but on a selective basis. And generally what we see is when you have macros turning in favor, we have lower interest rates, we have earnings recovery, then some of these businesses generally have a bit of tailwind. So post this correction, I'm long answer, but post this correction, I would say that we're not paint with the same brush that small and mid caps are very expensive. Selectively, it makes a lot of sense because you get right representation. As a fund manager, you want representation across businesses. So you pick and choose. And just to sort of conclude, like for example, mass consumption, discretionary space have been struggling for last 4-5 years. We have seen some pickup in autos, etc. And many of those sector leaders, be it footwear, be it building materials, they are either in mid caps or probably only in small caps. And you look at entire cohorts of capital market businesses, hospitals, they are in only in mid caps. So I would say that maybe 50-50 would be a right proportion.
Okay, all right. Tahir, one of the points that Nilesh mentioned were IPOs. Now, over the last few years, there are two factors with IPOs. Either they'll make you a lot of money once you get them in the IPO allotment, or they teach you a lesson that you'll never forget. The last year, actually, more number of the IPOs that came about, they didn't make you money. In fact, there were some of the biggest losers. What about that IPO frenzy? This is another year where we have big IPOs lined up, but there are a couple of interesting ones. NSE, probably you have a Zepto, probably you have a Geo as well. What is your view on that with regard to the IPO market and the pipeline?
So, look, I think there'll have to be a certain amount of moderation, both from the issuer side as well as from the subscriber side, as far as IPOs are concerned. And by and large, IPOs also are going through that same cycle. Again, I'll talk about mean reversion even in IPOs and valuation in IPOs. That's quite possible. Beyond a particular point, I mean, if I were to talk from my own experience, our own experience at Invesco about how we have conducted or gone about doing IPOs, we've not participated in all in sundry. I think at last count, the calculation that I did was, the statistics that I have is that over the last 2 years, we participated in something like 35 IPOs out of 120 odd, which basically are at a cutoff of more than 500 crores of issue size. Okay, and out of which about 70% of them have made money for us. 26 odd out of that 35 have actually made money for us. And more importantly, I think that from an investing culture point of view, I think there are only 4 IPOs from which we have completely exited today. Okay. So 31 are the ones which we have actually still retained in some form or the other. So that is a view that we take on IPOs. I mean, IPOs are not about, for us at least from our standpoint, it's not about flipping. We we essentially met the same treatment to IPOs the way we do to any other secondary market listed entity. And the same level of due diligence, research, etc., goes into it. So I think we have to be choosy, we have to be picky, we have to stick to business models which we understand, which we can probably buy from a 2-3 year perspective, if not more. And I think, but yes, I mean, from the point of view of the market, we will all have to be a little more reasonable in terms of what we want to, and everybody will look for more margin of safety for ourselves.
So, just for the benefit of the viewers and the audience who's sitting here, given by your philosophies, Sandeep, with your philosophy, Tahir, with your philosophy of mean reversion, 2 sectors, I'll ask all 3 of you all, 2 sectors which you guys are bullish on for 26, and 2 sectors which is a complete avoid for you, just for the benefit. I mean, if I know you can't talk stocks, but from a sector perspective, if you can show some, give some idea.
So from a quant mutual fund perspective, I will say power is a theme, it's a global theme. Okay. Last year it underperformed. So if I have to look at
the power index, by the way, was down 6% last year, and it's part of the mean reversion, which normally turns positive.
So that's the one theme which we think should play out very well. Okay. Second thing is about generic company, pharma company, which are not at all affected by the Trump tariff, whether it's 20, whether it's 500, doesn't matter. They are exempt space. That's the area where India has edge. Okay. And what IT did 20 years back, we think next 20 years, pharma can do that. So
what's a complete avoid for you? The 2 sectors which are complete avoid.
See, if I have to say completely avoid, obviously I will take a clue from our call. If we are saying that NVIDIA is the best shot for 2026, though it has not peaked out, it may take some more time, but that is the best shot, then I will avoid new age companies because if I'm talking about P contraction, then all expensive, most admired territory and most valuable stocks should be completely avoidable.
Okay. All right. Just one more point, Sandeep. The call on metals is we are nearing the peaking out phase even there?
So if I have to say it's a structure bull run, yes. But if I have to say a medium-term perspective, I think top is around the corner, whether it's 15 days or months' time. Somewhere you will see, like, first gold can peak out. Copper is also in a similar situation, but they still have not happened. Okay. So we are in the climatic phase. So this phase, whether I should participate, the answer is no. I will look for a selling opportunity or booking profit, not shorting.
Okay, the reason I asked you that because you're working with a stronger dollar. So, obviously then you have that correlation. Tahir, coming across to you, mean reversion is something that you've said from the start of this conversation itself. Couple of underperforming sectors last year were real estate as well as tech. Yeah. Do they find a place in your portfolio for this year? Will you be reasonably more optimistic about them? And give us your top 2 sectors as well.
So again, continuing with the theme, my theme of the evening, mean reversion, I think the 2 sectors, 2 or 3 things which stand out, basically tech, as you mentioned, is something that we're increasingly trying to build confidence around. And we know that it is not going to be really front-ended returns, but I think this is a good time where at least from a FCF yield perspective, we can probably feel reasonably comfortable that valuations are somewhere in our control at about 4.5-5%. It's not a bad point to enter. So tech is one, IT services that is. I think private banks is another one which is actually not done as much. BFSI as a headline index has done very well, 23-24% over the last 1 year. But when you probably drill it down a little further, and you'll find that private banks, actually the top 5 private banks have all done less than 20 or thereabouts. I mean, they've underperformed the BFSI index. Public sector banks, non-lending, Ramdevji mentioned that a little while earlier, they have really done exceedingly well on an aggregate basis. But I think it is probably now the turn of private sector banks. So probably that is, and especially if I were to probably keep in mind the fact that, we are by and large done with the interest rate cut cycle, more or less. I mean, we might have another 25 basis points or so to go, but much of it is actually done. And if we are probably looking at that changing over the next 12 months or so, then private banks probably have a better chance of improving margins and re-rating. Thirdly, I would say that there are some domestic cyclicals also probably make sense. Like, certain parts of auto, cement, etc. It's more about, see, it's, where I would probably differ a little bit is that with Sandeep is that it's, market is not gravitating from growth to deep value. It is becoming a lot more expecting of reasonable growth and reasonable price. So we are talking about market moving from growth at any price to GARP. I think in that is where, and especially if there is, once again, in the theme of mean reversion, I mean, if there are companies which have underperformed for the last 3-4 years or segments of the market which have underperformed, could be paints, could be chemicals, could be some parts of metals. Even certain consumer durables. I mean, it cuts across a swath of different kinds of sectors. If they've underperformed, then they probably, what we are also additionally glued on to is where is the possibility of earnings upgrades.
Right.
That is what the market is actually queued on to all the while. So are the likes of the Dixons and the Trents of the world going to give you earnings upgrades this time around, or is it going to come from the likes of maybe, I'm just throwing names, it could be a Voltas, or could be a Reliance, or could be some of the other durable companies, or many such which have probably underperformed, and even the paint companies and so on and so forth. So I think that is what the market will get a lot more queued onto. Instead of playing very, very durable themes, try and play something which is probably a little more cyclical, mean reverting, but probably provides you margin of safety.
Sure. Got it. All right. So IT services as well as private banks. Nilesh?
Yeah, so at an aggregate level, I would say that post the correction, recent correction last 15, 18 months, I think the dispersion in valuation is limited. So as a house, we are getting opportunities across most of the sectors. But as a house, we have been positive on the largest sector, which is the BFSI part, and also I mentioned on the consumer side, because you have confluence of factors where product prices have come down, courtesy GST, let's say autos, AC prices have come down. You have income level increasing, both on the rural side as well as on the urban side with the tax concession, and also the EMIs have come down because of the rate cuts. So I think mass consumer discretionary side from a longer term perspective, that sort of looks good. As I said, across that, we are getting enough opportunities, even in healthcare and many other sectors. The only sector I would call out, which is despite the correction, we are underweight or less representative, is this entire capital goods, or maybe some of those EMS name and all, because post the correction also, we don't find enough margin of safety.
Okay. Okay. Nilesh, I want to ask specifically to you. I mean, we can ask to all the three, but first to you. Just an example, I'm taking as a real estate as an example, and I want your thoughts. For real estate sector, everything which could go right went right last year. Interest rate cuts were happening. Every company on the street was able to raise funds and raise money. And despite that, the index is down 16%, the stocks are down 30, 40, 50%. What went wrong for the sector, and how do you identify these kind of red flags? If you want to identify something similar red flag in any of the sectors for 26.
No, you're right. I see what happens is sometimes a good trend or everything is going well will not be a good stock. Sometimes most of the commonality, if you dissect only 1 year return, it's not only earnings, momentum is an earnings surprise, but it's also what is the starting point of valuation. 15, 18 months, but starting point of valuation of some of these sectors were not so cheap. So that's why they would have corrected on a 1 year basis.
After the correction, Tahir, you think there is some bit of value? Sorry, I can ask you as well. You think there is value now in real estate sector stocks?
Yeah, we would be positive because they would, as you rightly said, most of the sales numbers have been pretty decent, and they are beneficiary of low interest rate regime, right? So to that extent, they would benefit, but it's not a very homogeneous sector.
Sure.
So one has to be very stock specific, unlike many other businesses.
Tahir, you want to come on real estate?
In continuation of that question about real estate, so again, that is one which can probably revert, and from the point of view that stocks have actually not done well, but it is not exactly reflective of the underlying trend in real estate. It's not as bad as what the stocks are making out to be. So it essentially presents an opportunity. And why I say this is that we started off by saying that valuations starting point maybe at the start of 2025 on the higher side. But I think developers at one level have pulled back by themselves. I mean, they've gone through their own experiences of the past, and I think they're behaving in a more rational way. So whenever they've seen a little bit of contraction of demand, they pull back in terms of new launches, etc. And I think that perhaps to some extent is also a function of market sentiments and so on. Cyclically, I think it can revert, and especially the longer term cycle, I think for real estate, we still remain reasonably positive about. So again, this is one sector which can, as 26 comes about, I think stocks will start aligning more with the underlying reality, which is reasonably fine, particularly as far as luxury, mid-end, premium. Affordable housing, of course, has got its own set of challenges, but I think most places where larger developers are actually focused is still in the play.
Okay, and Sandeep, you want to weigh in on the real estate theme?
So I'll give you an interesting perspective from the behavior side.
Okay.
What I say is correct. They are in neglected space. They have corrected a lot. And frankly speaking, numbers are not bad, at least for the larger listed companies. We are not seeing any big deterioration. Okay. I always see on the real estate side, when your wealth contraction phase come, real estate P multiple deteriorates.
Okay.
So we have seen last 1 year, because large portion of houses, premium houses, expensive, people make from markets.
Markets, absolutely.
In some form or other.
True.
Okay, so when you have a wealth contraction phase, your confidence level is low. You will not go and participate, The wealth effect is there, then everybody wants to buy a house, second house and third house, So it's more from a psychological perspective that impact is there.
Okay. Among all the volatility, the one big headline to me in the last 1 year was the FDI money in financial space. 5-6 large deals. RBL Bank now with an MNC. Shriram got a $4.4 billion of inflow. What have you reading this? Lot of FDI money coming to the financial space in India. And is there a sector to bet?
So I think this is a good opportunity, given since we are one of the largest shareholder of RBL, so we can say that and we track it closely. Given the USD INR situation and government and first time RBI allowing somebody to take over the controlling stake, here the challenge was 26%, we are offering 75% or 51%. So it means the mindset of the current regime has changed completely, which means there could be a great opportunity. And we have seen a couple of deals happening from the Japanese money coming to India, and there's a big queue. Okay, so this is the area. I think there's a great opportunity if you get something which is completely neglected and beaten down, and appropriate time, confidence capital can be infused. And for whatever reason, if they want to hand over the control also, I think is good news for this country.
Nilesh, you want to come in? I know you're bullish on BFSI, but the fact that so much of FDI money is coming in, how do you read that space and what it could mean for the sector?
No, I would concur. I think these are specific cases and happen to come together, three cases in particular. And probably it's also has a blessing of the regulator, and probably one of the lens of is also to be more pro-growth. So to that extent, I think there's enough and more opportunity in that space for many of those franchises to grow.
Okay, all right, gentlemen, we thank you all for that. But there are a couple of questions from the audience. Just like to throw the floor open. If anyone has a question, please, if you could raise your hand and we'll come across to you. Okay, I think Lata has a question.
Okay, there is somebody.
Hello.
Yes, sir. Please.
Panel speakers. Yeah. Hello.
Welcome to you, ma'am.
I had this question. In the real estate sector, like the luxury real estate is a very niche segment, but it is growing the most. Like if you see, like in 2025 only there was this news that around 20 flats worth 27,000 crore launched by DLF got sold within a very short span of time. So do you think that this will continue in like the premium luxury, or it has moderated in the coming years? Luxury real estate.
Yeah, I can take that. So like I said, yes, premium luxury is also growing very fast, and it is maybe somewhat of a niche, but generally mid to premium to semi-premium or whatever you call it, and then to luxury, I think it's becoming a larger and larger part of the overall thing, especially in terms of value. So the statistic is that in the last year or so, or 2 years maybe, the share of all premium, mid-premium housing, affordable housing rather on the other side has actually come down quite meaningfully, probably to about 25% of the total housing real estate market, from what was more like 50-odd%. So it is a fairly strong climb down. Is that going to go back to 50? It doesn't really look like. Today we are in a stage where we are, as a country, there is an upgrade cycle which is happening in real estate, and it is gradually progressing up the ladder. We have a significant proportion of our lower middle income households which are going to migrate to upper middle income households over the course of the next 5, 7, 10 odd years. And that essentially should probably sustain this upgrade cycle even further. It's happened in every country around the world, and we are probably one of the last large markets which are going to see that transition over the coming 5 or 10 odd years. So I think this is something which will probably sustain. It may have its swings, but this is where the trend is, and I think even the suppliers are actually trying to essentially drive the buyers in that direction. So that's how I would think about it.
There's another query that we have on the first row. Someone could just...
Yeah, can I ask?
Please.
1 minute. Let her ask the question first.
Sir, will money flow from equities to gold, silver?
Oh, this is something which everybody is asking now.
Well, I'll answer that.
Yes, please.
Okay. See, we don't have to look at it in a very short-term perspective. If you have to take a strategic call, like I always say, we have been saying for a while, last many quarters, precious metal is your tactical call in the global uncertainty phase. And this phase is not going to end so easily. Our view is till 2032, 33, this phase will last. So you should have 10 to 20% precious metal in your portfolio, despite I'm saying that from a very near-term perspective, both gold and silver can peak out. And you can see a very steep correction or sharp correction, 10, 15% correction. And we have to live with this. Maybe 2026, you will see more volatility in gold and silver prices than what we have seen. Last year was the easy phase. We are in bull run, but difficult phase of bull run. So it will be challenging. So I don't think one should look at money will shift on. Money is shifting globally to this asset classes. As I said, it's all about from leverage economy to real economy. This cycle will last for many decades. And that's the reason, if you go back and see how China has built the commodities thing in the last many years. So commodities in the real world are going to stay on a higher side. If you ask me, copper, let's say, is X level. Can it go by another 30% by year end, despite after a correction? Answer is yes. So we are in structured bull run. So you have to keep your planning in such a manner that it should not get disturbed. You should not participate now. Rather wait for maybe a quarter or so when it corrects. So buy on dip should be a strategy for you.
Okay, there's one more query. Yes, sir.
Yeah. So, as you answered the real estate as well as the current question of gold equity. So, so much data, so much information, rather information noise. So question to all of you actually, do you see AI is what now making, life easy for you, or is it the competitive advantage driver? So how you use AI internally? Curious to see whether that's a competition to you actually.
I'll answer it very simple. Any technology benefit, it increases our efficiency, improves productivity. Okay. So I don't think a lot of people look at the other way, it will lose job and all those things. I think it's in some segment it will happen, but when I look as an individual or from an analytic perspective, our life has become easy. Okay. What we can process in 15 minutes, you should take sometime few days also. So obviously we are beneficiary, as in the previous session we are also talking about. We should understand how to optimize these opportunity which is there, and everybody should use it.
Okay, all right. I think we can take one final question from the gentleman back there. If we could get a mic out there. Yes, one final question.
Thank you for such an enlightening discussion. A quick question. We've seen that quality stocks like TCS, Asian Paints, Hindustan Unilever, over the last 3 to 4 years have been more or less sideways. So what are your thoughts that will quality finally be taking a turn in this new year and going forward? Or do you still feel that these quality names at higher valuations will continue to face headwinds in the future?
Nilesh, you could take that.
Yeah, we cannot give a very generic answer. At a broader level, obviously, quality is always the last line of defense. In investing, you have to buy quality businesses as defined by growth, ROI, ROCE, and good management, and at a reasonable valuation. Some of the names you mentioned, I think for different reasons, each have underperformed. Most businesses we see are either impacted by disruption and or competition. In some cases, it's both that. So one of the paint names which you mentioned, there has been serious competition on that, apart from bit of headwinds on the sectors. Staple business generally are again disrupted because of the supply chain as well as they are low growth businesses. IT has its own sort of headwind. It was never a high growth sector. But those names, just because they have underperformed or outperformed, should not, as a construct, obviously, quality is very basic. It's very fundamental to investing. So obviously, no one would say that you would not buy. And how do you define quality? In our opinion, it is on the longevity of the growth and the quality of the growth, or the character of the growth as defined by ROCE. So I think in the longer term, wealth creation obviously happen if the business is able to intrinsically compound the value and the starting point of valuation is reasonable. We're not overpaying for that. But sometimes quality, the perception and the names which you mentioned is also probably as the stock has not done well because the starting point of valuation may be very high. some companies, some of the names were at 60, 80 multiple 3 years back, then obviously it ought to underperform. I mean, I remember a case, one of the staple companies in 1999, there was a 10-year of underperformance because the starting point of valuation at that point in time was a 60 multiple. So I think it's much more nuanced rather than a very generic answer or framing anything under quality, value sort of thing. But that said, quality is very fundamental foundation of investing and creating wealth in equities, through equities.
Okay, all right. Thanks a lot, Nilesh, Tahir, as well as Sandeep, for joining us, giving us those insights. On a personal note, I'll hope that, it's a batsman that's come to the crease, batted out the initial few overs when the ball is moving around, and hopefully we're setting ourselves up for a bigger innings. That's the note I'd like to end on. Thanks a lot. And thanks, Nimesh, for co-hosting this.
Thank you, everyone. Thank you.
Cuts, rates, or holds by what the budget signals on capex and fiscal consolidation 3 weeks from now, by whether US tariff threats escalate or stabilize, by how corporate earnings actually track versus expectations as Q3 results roll in through this month. And what does this all mean for portfolios? How do we position when the macro cross currents are this complex? To guide us through this, please welcome on stage Lata Venkatesh, Executive Editor, CNBC-TV18. And joining her for the discussion, we have 3 experts who analyze the economy and markets at the highest level. Neelkant Mishra, Chief Economist, Axis Bank and Head of Global Research, Axis Capital. We have Sajid Chinoy, the Head of Asia Economic Research, JP Morgan, and Gautam Chowcharia, the Head of Global Markets, India, UBS. Ladies and gentlemen, a huge round of applause for them. Over to you, Lata.
Well, budgets are always welcome for the markets. But actually, at this moment, we are at a juncture where things are a bit puzzling. Until now, we never spoke about nominal GDP. We always looked at real GDP, but suddenly things are turning. Until now, we always thought lower inflation is good. For the first time, we are cursing inflation for being so low because it's hurting revenues, it's hurting top lines. And for the last 2-3 years, we actually have not worried about fiscal deficit, even though it was at 10% and then 6% and then 4.4. It was kind of bridged pretty easily. We never worried as in the last 2-3 years, that tax collections will not be robust. In fact, we are 2 or 3 surprising years when tax collections beat budget estimates. But now it's kind of back to pre-COVID days when we are beginning to worry whether revenues will be enough to cover the deficit. And these 2 peculiar worries that we have, whether inflation and nominal GDP will be back up again. That is kind of the context in which budget is playing out. And that is also the context in which earnings are playing out. We almost want inflation and nominal GDP back. So with that backdrop, I'm going to shoot the first question precisely on those lines. Sajid, to you. What is your sense in terms of real and nominal GDP? Are we going to keep that 8% number? And are we going to get back on nominal GDP to double digits above 10%?
Thank you, Lata. It's good to be here. So I think let's just look at real GDP first. And I appreciate that this year could be 7.5%. But this was also a year with multiple cyclical tailwinds, right? You had direct tax cuts, indirect tax cuts, monetary easing, regulatory easing. We sometimes forget a positive terms of trade shock. Oil prices fell by 15%. Strong monsoon and low inflation with boosted purchasing power. Not all of these factors will repeat next year. So I think in thinking about real GDP over the next year or two, the government will probably be conservative and say we go back to about 6.5% or thereabout in terms of real. Now, I think the nominal GDP, there's an overshoot and there's an underlying secular trend. This year was perhaps an overshoot. The GDP deflator this year is 0.5%, which is the lowest in 50 years, right? Because you had 2% CPI inflation and 0% WPI. Those things will begin to mean revert next year. On that lower base, you'll get CPI closer to 4%. But let's not forget the elephant in the room, which is China has got massive excess capacity, something we've discussed for the last 18 months. And there's no sign that domestic demand in China is turning up. And to meet your 5% growth target year after year, you're just producing more and producing more. And the world has to absorb that. So I don't think the Chinese excess capacity is going away anytime soon in 2026. That's going to force disinflationary pressures around the world, but particularly so in Asia. And remember, yes, we've got geopolitical risks, including Iran. But if you look at the fundamental balance in the oil market, this is the pressure will be for oil prices to go down, not up. So I think while you get some mean reversion, we're now in this new world where inflation is going to remain low, and we have to get used to that. So I think prudently, real GDP of 6.5%, a deflator somewhere 2 to 3%. So if you're being very conservative, you'd probably bank nominal GDP at 9. My sense is the government will probably budget 10% like it did last year. And make one final point. You spoke about how nominal GDP affects tax revenues and earnings. There's another critical component, which is debt dynamics. The government's committed to a debt consolidation path of 50%. The lower nominal GDP you have, if you've got 9% nominal GDP for the next 5 years versus 10%, it means you have to do more primary consolidation of the fiscal to get to your debt target.
Oh, yes, that's the other googly, which I did not refer to. We are used to looking at the budget and looking at the fiscal deficit numbers, but now we have to look at debt to GDP numbers. I don't know whether they will even mention a fiscal deficit and a target in the current budget. They might as well speak just about the debt to GDP. But okay, you think they will have to?
They have to give a borrowing target.
They have to give. Oh, no, but it's very tempting to get to earnings. But since you gave me a question on the platter to someone who has been a long-time metals analyst before he became an equity strategist and an economist, Neelkant, really that question to you. Will we continue to be bedeviled by a very low WPI because of this Chinese dumping? Two questions, actually. How do you see metals itself? Do you think this copper at $13,000, etc., will peak off? Or do you think, we are, going to be bedeviled by this Chinese disinflation and therefore low WPI?
See, I see the metals in three parts. So there are the precious metals, which are a proxy for wealth, for buying something when you don't trust any currency. When there is competitive debasement happening globally, then you want to get into them. I also kind of agree with the previous panel where on the 3-5 year basis, I think the precious metals are going to do much, much better than they've done. But if everyone around you is screaming buy gold, buy silver, then as a market observer, you kind of start to taper down. So
underperform now, but they still remain long-term
exactly. So, but precious metals, and they do affect CPI for what it's worth, but fundamentally, they are not really a big driver of inflation. Then you come to the base metals, where there is possibility of financial involvement. And I think in some of those, like copper and zinc and lead and so on and so forth, I do think that we can see continued increases because some element of that gold-silver balance, because people will start to bet that if there is going to be competitive debasement of currency, at some point these metals, which are hard metals, which will start to rebound. The only risk I see is potentially for aluminium, which I think is priced very high, given that the price of energy is falling. So there can be financial market interest, but if oil stays at 60, coal prices are lower, power prices are at 1 rupee a kilowatt hour, I think it becomes challenging to sustain aluminium at that level. On ferrous metals, I still think that iron ore at $100 plus is too high. There are specific capacities coming in, and I do think that beyond the immediate restock that we are seeing, there is a bullwhip. So the world destocked in anticipation of a big disruption. Then people figured out, oh my God, the economy has not done that bad. And therefore, the inventory rebuilding starts. There is a bullwhip effect. Steel demand is held up globally. But I think ferrous is at a level where it cannot sustain. So it will decline. But on WPI, I still think that food and vegetables are a very major component which have dragged it down. And I think that I think real GDP in FY27 is going to be better than the 6.5 that everyone is expecting, far better, primarily because the fiscal headwinds reduce and the monetary becomes a tailwind. So now we are seeing credit growth accelerate.
But monetary was a tailwind this year also. I mean, we saw the governor's, 4 rate cuts coming by June, then he was flooding with liquidity.
The monetary tailwind becomes effective. So first is that you press the button. Now, when did it really hit the ground? Is when credit growth starts to accelerate. So it is only now where in the last fortnight of December, where suddenly what used to be a 0.8% fortnight over fortnight became 3%. There were some 6.2 trillion rupees of loans that were disbursed. Is that suddenly you find that there is, some of it is, I think, share from bond market, share gains from bond market, because yields went up, so the bond issuance fell. But it's now that credit demand is coming through. And when people borrow, they will spend. And when they spend, that drives the next level. So what was a vicious cycle is now starting to become a virtuous cycle. Now, how long it lasts, time will tell. But I think that the real growth next year is going to be better from this year's perspective. And
this year's is 7.4, but even that looks conservative. You think it'll do better than that?
Yeah, our forecast is 7.5, but 7.4 is also somewhat statistical. Second quarter was on a base of 5.4. But 7.5 next year will feel much better as well. It will feel that people are excited. And the very fact that it seems that companies are also now starting to invest, it will make it a much more all-round kind of growth. So while I agree that I think nominal is what the government will start worrying about, I think a double-digit nominal GDP growth next year is a reasonable assumption.
Okay. So you mean something like a 7.5 plus 3.5 is easy to assume.
So 10.5 is a reasonable.
Is a reasonable assumption. Okay. The tragedy of this year, or perhaps the disappointment of FY26 has been so far. We still have 2 more quarters of results to come. The tragedy has been that in spite of this 8% second quarter GDP and 8.2 in the previous quarter, it didn't show up in earnings. Earnings for 6 quarters was low single digits, at least as far as Nifty companies were concerned. Do you see that changing? First for Q3, Q4, and then for FY27?
So look, earnings growth picking up, I think is a kind of a given almost. Even with the normalization of nominal GDP, that itself should get a kicker to earnings growth. So I think that's less of a debate. Issue is, does earnings growth pick up to double digits or to teens? That's the debate.
Yeah, exactly. Is it 10 or 15? What's your guess?
Exactly. So look, markets are pricing in 15. If you look at the headline multiples in a theoretical construct, 10-12% everyone expects. That's one of the key things we are watching closely. The credit cycle picking up. Banking system is one of the best capitalized we have seen. There's more capital coming in. And one of the most difficult things to track, and we're seeing early signs of that, is credit standards. What's the risk appetite of the banking system? Like we had Sanjay earlier talking about aspirations to grow. Even the large private banks, which we saw in the last couple of years being fairly conservative, if I can use the term loosening the purse strings, it's happening, early signs. So that's the key variable beyond fiscal, beyond trade, whether credit growth picks up or not. We are seeing early signs of that, for sure.
You're seeing early signs of credit offtake. Okay. Well, actually, to get to mid-teens credit offtake, corporates have to borrow. I mean, retail can take you that far, but the real kicker comes when corporates borrow. Is the capex cycle really looking like taking off?
Not just yet. And I think what we're seeing in India is a rotation of demand drivers. And I think that's important to recognize what's happening, right? So for the first 3-4 years, we actually saw government capex doing a lot of the heavy lifting, and the real estate cycle was very strong. But if you look closely at the data, government capex is now growing, still in double digits at 9-10%, but not at the 20, 30, 40% it was in the previous year. So that impulse has slowed. You look at real estate and a broad variety of indicators, still reasonable growth, but not the rates we were growing 12, 18, 24 months.
No, the last numbers are actually
exactly,
bad. The
exactly.
number that...
You look at cement, you look at steel, you look at housing loans, you look at a variety, top 7 cities and the like. So what you're seeing is the initial drivers of growth post-pandemic have slowed, but new drivers have picked up, and consumption, of course, is the big one. Rural had picked up earlier. You're now seeing autos in particular pick up. For me, the key, Lata, is what is the durability and the breadth of this consumption pickup. Everyone expected this quarter to be strong because it's a double-barreled approach. You've had indirect tax cuts, rate cuts, the 7 factors I mentioned. The question is, 3 quarters from now, will we still be seeing, consumer durables doing well, and will this broaden out beyond autos? If that's the case, then I suspect there's enough demand visibility for corporate capex, which is happening in pockets, to broaden out. I think we're underestimating the fact that there's still a lot of global uncertainty, right? So you've got to marry capacity utilization going up with animal spirits. If every single day you're worried about another tariff and another event shock in the world, and you've got all this Chinese excess capacity, my suspicion is the threshold on utilization rates will have to be higher. So I think we need to be a little bit patient. This is a sugar rush. We're in the midst of it. We need to see if this rotation and growth drivers continues for 3 quarters to then crowd in private investment.
Okay. Well, you're betting that capex cycle is well underway. I thought I read a copy of yours.
Yeah. So whenever someone says, "Oh, capex is not happening," I say, "Show me the data," because everything I see shows that capex is happening.
No, actually, no one really gives us a private cycle, private investment data. We get the CMI data, which is overall. But private sector itself, you feel convinced is...
So you look at the BSE 200.
So you hear data centers, you hear renewables, but we don't have an aggregate number.
Why? Because you look at BSE 200, top 200 companies.
So you're looking at net assets of those companies.
The balance sheet, the cash flow statement that comes, there is an investing cash flow. There is a reasonable breakdown of what is it for M&A and what is it for new investments. You get that data, and that has been growing faster than nominal GDP for quite a while now. September quarter, or September first half, that is the first half of FY26, it grew only 5%, but that was primarily because of telecom. You take telecom out because the 5G capex is done, it's growing at 15% year on year. So there are several such measures. So if you know, in the December quarter, our cement analyst estimates 8 to 9% growth in cement consumption. Now, that does not mean you start buying cement stocks because there is competition happening, EBITDA per ton is not good. But cement is not something that you can build inventory on. Cement cannot be consumed by itself. It will mean that you need to consume steel with it, you need to consume labor with it, sand with it. That means commercial vehicles will move. You look at the movement of commercial vehicles. Some of the road operators are telling you that the FASTag usage, the number of times a commercial vehicle taps into these are all up dramatically year on year. So there are many signs that the investment is trying to pick up. And where do you think the last months or last fortnight's credit growth went? I mean, some of it went to NBFCs, but a lot of it went to corporates.
Okay. No, I would be very glad, but at the moment, you get very clear evidence.
No, it is one of those, that because everyone is saying capex is not happening, it is fashionable to say capex is not happening. I don't understand.
I'm not saying it's not happening. I'm asking you if it's happening.
No, but you made up your mind. And I think that...
No, on the contrary, we had CMI on the channel just yesterday telling us very clearly that he is looking at net fixed assets, and that was growing at 4.5% in the 5 quarters to September 2022. From September 2022. But in the last 5 quarters, it has gone up to 6.5%. And only for September 25, he's seeing it at 9.5%. So he's very convinced that there is a private sector capex cycle.
And you can see that
but
in the order
hear
books.
The steel companies giving us the kind of investments
you really want
we heard in the
you really want that to happen? That when I was a steel analyst when that was happening, it is scary when your industry capacity is 45 million tons and you have 80 million tons of capacity under construction. You have 130 gigawatts of thermal power capacity and you have 200 gigawatts of thermal power capacity under construction. where half of them don't even know where they're going to get coal or water or linkages. So this is much more sane and it is much more sustainable. And when you look at order books of the industrials companies, they're all looking pretty good. I mean, why do you think some of these stocks have done so well in the last 3-4 years? Because order books have grown. They're seeing the capex.
Okay. Well, so the power stocks have done well for a whole host of reasons, but again, we are seeing them peaking off. We are seeing real estate stocks peaking off because the latest number that came from all the real estate companies, real estate market watchers, the Knight Franks and the JLLs, is that residential sales is down to 1% in the last quarter. So there is some skepticism about residential real estate for one, not so much with office space. Office space is doing very well. But residential real estate, the last numbers, I mean, you saw what Signature said, and that led to all the real estate stocks falling.
No, but I don't want to hog the conversation, but the real estate cycle also, remember that FY25 was where we saw simultaneous fiscal and monetary tightening. FY26, the pace of fiscal tightening slowed and monetary was no longer tightening. Remember that till December, credit growth was still 12%. FY27 is where you say even less of fiscal tightening and monetary easing, basically credit growth accelerating. That is when you see. So the only indicators for the real estate cycle are inventory and price to income ratios. And both look extremely healthy to me.
Okay. No, there are a bunch of pre-budget reports that brokerages have put out, and many of them are worried about growth. They're not as sanguine as you are. And one of the asks, Sajid, and that question is to you, is that why should we worry so much about the fisc? I mean, look at the kind of fiscal deficit the United States is running, or so many other countries are running. And therefore, why should we bring it down from 4.4 to 4%? I think it was Bernstein's report that came today, asking that let the fisc spend so that the growth stimulus is maintained. Is that something the budget should seriously consider?
I think first and foremost, using the US as a benchmark to say because the US is doing it, India should do it, is not a good time to make that comparison, right? We're the elders in the room right now. The ECB just came out with a statement half an hour ago in solidarity with what Chairman Powell said. So I think the US is not a good example. Listen, you can't have it both ways. If you believe that there is a cyclical pickup, right, then you have to believe in the counter-cyclical dharma of monetary, macro policy, fiscal and monetary, right? The government's thrown a lot at the economy in the last 12 months. As Nilkant said, some of these have transmission lags. You've had direct tax cuts, indirect tax cuts, monetary easing and regulatory easing. Now, we also have a debt target. And these things matter. One of the reasons India has been so stable in the last 4 or 5 years, or the last decade, has been this institutionalization of macroeconomic stability. That frameworks matter. Monetary frameworks matter. Fiscal frameworks matter. The government just the last couple of years has says, we want to stabilize debt and bring it down. And the central government has given you a debt trajectory. Now, even if you be liberal and say nominal GDP is going to be 10%, I think it's going to be lower in the next 4 or 5 years, not because real GDP is lower, but because we're in a different disinflationary world. The primary deficit at the center has to come down by at least 0.5% of GDP to get to that debt target. If nominal is lower, then the ask on the primary deficit is even higher. In a year like this, where there are all indications there's a cyclical pickup, if you were to deviate from the fiscal deficit target, investors will ask, markets will ask, foreigners will ask, if in a year like this you can't consolidate, when will you? So no one is asking for draconian consolidation. If you've got 0.5% in the next 5 years, you do it in slowly. But I think directionally, it's important to take that deficit from 4.4 to 4.2 to say we're committed to that. We shouldn't underestimate that when risk premia come off in all markets, that's good for growth.
Okay. I think the best phrase I like this, in a year when it clearly looks like there is a cyclical uptick. So clearly, all three of you are on the line, on the plane that there is a cyclical uptick and that there is that is married to an earnings uptick as well. Okay, so now let's come to brass tacks. Gautam, where will the best growth, earnings growth show?
I think the obvious one is financials, as we were discussing earlier, the credit cycle pickup. Even if you don't see a credit cycle pickup, just the pickup in nominal GDP will drive upside there. And it matters because that's one sector in the broader Indian market landscape, which is still risk-reward-wise reasonably valued. So most sectors, when you say rich valuations, We try to hide behind valuations versus last 3 years, last 5 years, but last 5 years have been different valuation paradigm for the market. Financials is the only sector which compared to last 10 years, 20 years still looks attractive. So financials is one clear one. And then there are pockets which is less linked to macro, like someone had mentioned power earlier. The entire space from utilities to equipment providers, from any scenario you look at, the growth in the next 5 years, whether it's power loans or power T&D demand, is going to be significantly more than what we saw last 5 years. And the sector is not priced for that even now. These two are the obvious standout ones. And then it boils down to more stock level rather than sectoral level. That's the way I'll put it.
So, sorry, what is the last?
More stock level than at a sectoral level.
Okay. Yeah. Okay. Well, time permitting, I'll come back to sector questions to Neelkant as well. But, you guys are giving me the feeling that the economy is doing exceptionally well. One of the areas which has bothered us has clearly been the external sector. And the fact that the FPIs have stayed out. There has been a depreciation of the rupee of 4 to 5% at a time when rival currencies have actually appreciated. Now, Sajid, how are you looking at both the rupee and the balance of payments? This is the first time since 1991 that we have had 2 consecutive years of BOP outflows.
Yes.
We've had current account deficits, yes, but balance of payments outflows, current plus capital leading to an outflow, this has been a bit of a scare. Do you think it corrects this year?
And I think what's salient is that you haven't had the BOP outflows because the current account deficit is ballooned like we had in 12-13. You had very contained current account deficit, and yet you've had BOP.
It was 5% in FY13, and this year it is 1%.
It's a capital flows issue, and I think in a way India is experiencing or going through a perfect storm. Right? Why is it important for private capex to pick up? Because I've always felt over a long period of time, your net FDI is complementary to a domestic capex cycle. When you get capex for years, FDI will come. If you don't have capex for years, then you're at the whims and fancies of individual sectors. So I think that's one of the reasons why FDI has not come in, and we're seeing some outbound FDI. And I think the equity market, others are more competent, but you've seen a rotation away from India to markets like China. Other markets in Asia have also done very well, like Korea. And I think on the bond market, the index inclusion story is done. And I'm not sure the interest rate differential in India's favor is that attractive. If you want interest rate thing, you'll go to a high yield economy in other parts of the world.
As we now know, Bloomberg index inclusion is not at least happening mid-year.
Correct. So I think it's one of those things where, you know what they say, focus on the fundamentals, the other things will take care of itself, right? I think it's really important for growth to sustain, as we discussed, for this rotation to sustain, and for private capex to pick up. If those things happen, right, we will organically attract more flows. It may take a few quarters, it'll happen, right? So I think there's nothing we can do to say, yes, of course, you can have incentives, tax incentives, other incentives, but those are short-acting things. In a world with so much turbulence, if your fundamentals correct, India will attract capital flows accordingly. I think that's where the focus needs to be. One other thing I'll say, two quick things. We should not panic. If you have a BOP deficit of 30, 35, 40 billion, given the quantum of reserves we have, there's no need to panic at all. This is not 2030.
It's just $22 billion last time and $5 billion perhaps.
And secondly, there is a strategic opportunity for India. If there is going to be calibrated, gradual depreciation on India, that's not a bad thing. Please, let's not confuse a strong economy with a strong currency. Every country in the last 100 years that's grown at 7-8% for 20, 30 years had with it a mildly undervalued currency to help exports. If ASEAN effective tariff rates are 18% or 17% and India's effective tariff rate is 35%, some degree of calibrated rupee depreciation reduces that disadvantage. If we're complaining about cheap Chinese imports, guess what? It's much better to let the rupee depreciate than to slap on a tariff, which then also hurts exports. Right?
I read your article on the advantages and why the Reserve Bank should allow currency to depreciate. And for 30 years covering the Reserve Bank, I've repeatedly been told that depreciation is good for us. It's a message that we have to give.
This is the test.
Is this worrisome? I mean, at the manner in which the rupee fell in the past few weeks, past few months, is it something that you're going to see in, we came from 84 to 91 in 12 months. Is that the kind of pace we should be prepared for in 2026?
I don't think we need to fall at that pace at all. I think the long run, we have to understand if India's inflation goes back to 4.5%, and the world goes back to 2%, 2-3% depreciation in a year is par for the course, right? Now, it never happens in a linear fashion. Some years you'll have no depreciation, some years you'll have 5 or 6. As long as it's not disruptive, a calibrated depreciation is actually healthy for the economy.
Okay, what are you picking up, Gautam? Are FPIs looking, since all of you believe that earnings growth should come to double digits or maybe mid-teens this year, you think it's a matter of time before FPIs come in? You don't have to worry about it?
So look, FPIs is two-part. One is EM in general. FPIs have not been investing in EM, not just India. And last 1 year, it's been more India versus other opportunities in the tech world, China, Korea, etc. For FPIs to come back, again, going back to the earnings debate, 10%, will it force them to move capital away from China, Korea, etc. to India? No. If earnings goes back to 15% plus, India still represents one of the long-term growth visibility markets for FPIs. So for FPIs to come back in an absolute sense to India, we need 15% earnings growth.
Okay. Well, let me therefore get that question to you, Neelkant. One of the reasons I'm getting from the market is that the difference between capital gains for debt and equity is too high, which has led to the seminal flow of money into equity, making our equities expensive. So there are various ways in which this argument that the capital gains tax between fixed income and equity being too high and needs to be bridged comes. One is that it's driving away the FPIs because it's made our equities expensive. And there are other reasons. The banking sector is not getting enough money because bank deposits are, made to look negative or have a tax disadvantage. Debt funds also have that tax disadvantage. Is that something you would advise the government to do, to correct this extreme difference? At least for an HNI, it's 12.5% LTC, long-term capital gains in equity, and probably 40% given their tax bracket. So is that something that needs to be corrected?
The first thing is, I don't think this is a new development. And so I would not want to
It's new
link...
in the sense that the indexation, etc., is just about 2-3 years old.
Yeah, no,
and it's coming to a head now.
I agree. So FPI outflows and say the valuation premium. So India's P premium to the world is now down to, I think, much below average, closer to the 10-year lows and all that. P premium to emerging markets also is at 6-7-year lows. So if that was an argument, it is no longer applicable, that India is way too expensive compared to its own history versus the rest of the world. Is there an arbitrage or is there a problem for banks to get funds?
We had that premium when our earnings growth was like almost 15 to 20.
That's what
now
Gautam
we are
said.
trying to have that premium.
No. But that is what Gautam said. That we also had, given that we made the mistake of doing monetary and fiscal tightening at the same time, between October 24 and October 25, India was among the large markets the worst in terms of earnings downgrades. So we saw 13% downgrades in earnings. So if the downgrades end, because the growth is now starting to come back to par, the roll forward gains will happen. Our forecast is CY26, we see 14% growth. And that should give comfort and bring some interest back. But
you feel confident that FPIs should come back in 2026?
First, I don't see, other than the balance of payments problem, which I think is also because FDI repatriation has gone from 20 billion a year to 50 billion a year because of, VCPs getting exits. But
that is also related to the valuations.
It is,
for instance, Whirlpool.
Whirlpool
clearly said that we are listing here so that we can pay off global debt.
Yeah, I know. And so LG is doing that. So there are many companies that have done it. But the point is that it is because these exits are possible that you are seeing everyone making a beeline for Indian assets. So FDI is going up now. So gross inbound FDI has been inching up, and now it is starting to accelerate. So I don't worry too much about the balance of payments. FPIs will come in when they have to. I think that if earnings growth comes up, at least the relative underperformance, the fact that China, Korea, Taiwan were getting all the flows and we were not, even the limited EM and Asia flows, that disadvantage should go away.
Okay, but to come back to the capital gains, do you think that correction
See,
is
first
something-
is I don't see.
Actually, I'll start a rapid fire on what do you all want from the budget.
So there is a there are 3 points here, right? The first is the FPI, which I think because the P premium has come down, once the earnings growth goes up, it'll go away, and the FPI flows will come back. The second is whether banks are getting adequate money, but that is conceptually wrong. I think the deposits will always remain in the banking system. So the cost at which the banks get it changes, but
so even ALM mismatches. There are other issues when the money is there, but it is in a kind of swift-footed current account or something. But be that as it may, my prime question to you is, do you need a change in the capital gains difference between debt and equity, fixed income and equity?
I don't think that is likely to happen.
But do you want it to happen?
It does not matter what I want to happen.
All right, it's unlikely to happen.
No, but I do think that I think the fact that our term premia are too elevated, and the fact that the equity risk premium being close to 0 or negative suggests that equities are considered safer than sovereign bonds is a big distortion. And I do think that taxation has a role to play there.
Okay. So let me continue that with your ask from the budget. What would your... if you want to make it expectation, I'm fine by that.
So I think that a continued fiscal discipline, some amount of acknowledgement that next year the pay commission will be due with some arrears because the counter has started. And therefore, this year the consolidation needs to be faster than would have been required if the pay commission was not due. And second, I think continued investments, some pickup in roads capex because that has been disappointingly weak. Some increased investments in urban infrastructure because that's absolutely critical going forward. And I guess, from an ask perspective, there's nothing more to ask.
So you're expecting pay commission to hit us only in FY28. It's not an FY27.
Yes, that is the term, right? So the pay commission has a term. That term, I think, will end about March of 27.
Yeah, it ends this year, so perhaps it will come. Sajid, ask and expectation.
Yeah, so you have a finance commission this year and a pay commission next year. Ask, I think, is quite simple. That I think there are limited degrees of freedom on the fiscal. So I think gradual, credible consolidation, keep the fiscal math clean. But I think the big expectation and ask is not on the fiscal math, right? It's on the reform agenda. And I think what you've seen in the last 3-4 months is a pickup in reforms, and this is a great opportunity to accentuate that process. What I'd be looking for is there's 2 high-level committees on deregulation, right? And I think this needs to be one of the avenues in which several deregulation measures are announced. We focused a lot on internal deregulation. What I'm hoping, expecting is there's external deregulation. What do I mean by that? We've signed a slew of FTAs. There'll be one more with the European Union soon. To facilitate that and to exploit that, you need to clean up your customs import system. So what I'm hoping is get a significant simplification of customs duties, the whole regime, not just rationalization, but simplification, that import duties come down. Remember the old adage, an import tariff is the same as an export tax. Duty. If you want to push exports, you have to rationalize the import front. We're seeing some progress on QCO. So I think a whole theme around cleaning up the import side so that we can exploit these FTAs and drive labor-intensive export-led growth. So I would think, for me, it's more about the reforms this year than the fiscal math.
I heard about export-led growth in my college days as well. I heard about labor-intensive exports from my college.
But the government
days,
has walked the talk in the
waiting for
last 18 months because right from the 2 budgets ago to the last budget, a focus on labor-intensive exports, customs duties are still high.
I know we have a PLI for textiles, but we haven't heard much.
But the cut on the removal of QCO on VSF, PTA, all of those have been remarkable changes.
So import tariffs have to come down more, and we've signed a slew of FTAs. So I think at least there's clear progress in that direction.
Okay, Gautam, expectation and ask.
Yeah, again, look, I'll agree with most of what Nilkant and Sajid said, but on top of that, this is still the early part of the 5-year term. So this is a good period, not just to talk about reforms, but also an opportunity to lay down a roadmap, both in terms of fiscal consolidation, not just headline, but how the resources will come when pay commission happens, or how will the resources come for pickup in capex. Like we've had a controlled capex spending because of fiscal pressures, but in the next 3 to 4 years, how do we drive capex up? So the roadmap, this is a good time to lay it out. That will be very, very interesting.
Okay, are you expecting that? A roadmap on the fisc?
The roadmap has been given. So the FY31 target, the debt to GDP target is given. Perhaps what Gautam is asking for is, what does it mean for tax to GDP?
So
and
that 50%, is what maybe give you an year-on-year target in terms of debt to GDP. Now, the most important question, in spite of the fact that we are, breaking the time limit, I wanted to ask you, what is your expectation in terms of the US-India trade signing? Is it something that you're expecting in a quarter or so? And do your growth forecasts stand even if that doesn't happen?
Yeah. I've been saying for a while, and I continue to say that. I don't think the US trade deal really matters for my growth forecast. I'm alarmed and amazed at how meaningful people think it is. I don't think so.
At least the last few months have proven that it is not as disastrous as people thought it was 6 months ago.
Yeah. And given that the Supreme Court is now the Supreme Court of the US is now likely to deem the IEEPA tariffs as unconstitutional, I don't think both sides are in a hurry. You look at the US President's Truth Social posts on how damaging it will be.
How damaging it will be if it's written back.
So basically he gets a sense that the court is ruling against him. So now the US government will be forced to levy a flat tariff on everyone, in which case there's no point India ceding ground on anything if there's no benefit to be had. Will there be using that Lindsey Graham bill, an extra Russian oil tariff and an extra Iranian oil tariff? That's between them. The remarkable thing yesterday, which the new US ambassador said, the Pax Silica, it confirms what observations were showing, that if Intel and Tata Electronics can sign memorandums of understanding, it is clearly with the US government's blessing. If Apple is expanding big time in India, if Google and Microsoft and Amazon are investing big time in India, these are all signs that India definitely is part of the tech hardware ecosystem as they see it as a counter to China. So if those things are on the way, the rest of it is, I think, enough.
Well, I hope so. I didn't feel that confident when I heard this morning that tax on Iran and the way in which a lot of small exporters are getting worried. No, every day
is $1.3 billion.
Bit of bad news.
No. But this is our own fear. See, remember that for India, Iran is far less strategically important than Russia is.
I agree. Right? For KRBL or for that specific company, it's a very big deal. So, that same thing with, even the Indo-US. It's very big for Gokuldas. It's very big for some specific entity.
Specific companies. But when you're thinking about...
and that is a lot of workers. That is a lot of laborers in Surat.
Absolutely.
A lot of laborers in Coimbatore. So we have to worry.
Absolutely. I think we have to worry about them. But when we are doing our GDP forecasts in a $4 trillion economy with 60 crore workers, even if it is 15 lakh workers, that is 15 lakh workers, right? But it's a 60 crore workforce.
Take your point. Yeah, go ahead.
I'll just say, I think we have to separate short term from long term. I think in the short term, India's exporters have shown resilience. Right up to November, what you've seen is what you've lost in the US, you've more than made up to in the rest of the world. But you can't be sure that continues. And for me, it's the indirect effect in the long term, which is, we just spoke about FDI and we spoke about the need to promote exports. And I think for that, you don't want to be sitting with the 33-34% tariff on the largest economy in the world. So if this takes 3-6 months, fine. But in the medium term, to attract FDI and investment and fulfill our export hopes, we should need to aspire to be in the same ballpark of where ASEAN tariffs are. So I think short term, we can be resilient, but medium term, we should be working towards the deal. And I'm sure at some point, given what the US ambassador said, things will eventually roll
And we hope the US Supreme Court is also working on our side.
Oh, yeah, absolutely. And see, the IEEPA will not last. I mean, I think these tariffs, country-specific tariffs, the legislature delegating major decisions to the executive is unconstitutional.
One thing that markets have constantly done is underestimate Trump efficacy. Now, there is Section 122, there's Section 232, there's also 301 and 338. And you would say, listen, the bar on 301 and 338 to do country-specific tariffs is higher, but in a land in the US now, where everything is so centralized, an investigation can take 48 hours, right?
Yes.
So we just need to be a little bit wary.
Actually, we should be getting on to another discussion on this, unfortunately. Out of time, but I'll take a rain check from both of you to continue on, how the, trade and its eventual evolution in terms of tariffs can impact growth and how far the US can proceed with its unilateral behavior. But that discussion for another day. I came into this hall with a little bit of pessimism. In the first 1 week or 10 days of 2026, we've lost something like 2% on most of the major indexes. And there was this continuous slings and arrows from President Trump every morning. But I'm going back with the confidence that FY27 and the remaining 2 quarters of FY26, we're probably going to see double-digit growth. We're going to see double-digit nominal GDP growth and perhaps better times even in terms of currency and FPI flows. Thank you very much, gentlemen, for re-inspiring confidence in me and my viewers. Thank you very much.
Thank you.